Good morning. It's Thursday, December 8th here in New York City. This is Yahoo Finance Live. I'm Julie Hyman with Brad Smith and Brian Sazi. And here are the top three things you need to know as the clock hits 9 a.m. Futures are slightly in the green on this Thursday morning. With the S&P 500, though, still on track for its worst week since September. Investors, of course, turning their attention to next week's Federal Reserve rate decision.
The collapse of FTX continues to roil the crypto market. The latest on that drama is Representative Maxine Waters says a subpoena is on the table for founder Sam Bankman-Fried.
And meme stocks are nursing double-digit losses for the year, with GameStop reporting another brutal quarter. So where are retail traders now? We've got the results, and we're going to break those down. And in a new survey, you'll find even more insights in just a little bit.
All right, but we begin today with our top story. Sam Bankman-Fried is back in the spotlight as federal prosecutors are reportedly investigating the FTX founder over whether he manipulated the market for two cryptocurrencies to give his business a leg up. Meanwhile, at the House Financial Services Committee, Chair Maxine Waters is setting the record straight on Twitter over her willingness to subpoena Bankman-Fried to testify at the December 13th hearing. Yahoo Finance legal reporter Alexis Keene is here with more details. Alexis.
Hi, guys. Yeah. So here is the understanding that I have so far of this New York Times report. What the Times is saying is that federal prosecutors in Manhattan are broadening the already existing investigation into Sam Bankman-Fried and into FTX to look at whether he and or his firm have manipulated the prices for the tethered cryptocurrencies Terra US and Luna. Now, that would be to benefit his firms Alameda and or FTX. And the hypothetical here, and this is something that has been shared with me with Yahoo Finance's David Hollerith, what he says the hypothetical would be here is that Alameda, the hedge fund for Sam Bankman-Fried and FTX, that Alameda may have placed trades with crypto lender Genesis that would then caused a Terra sell-off. The New York Times says that a bulk of the sell orders for Terra US dollar back in May when the cryptocurrency collapsed, that they appeared to come from Sam Bankman-Fried's firms that had placed a big bet on Luna failing. And of course, those two cryptocurrencies tied together, trying to be pegged to the US dollar. The New York Times says it's not certain that this is what happened. Also, they issue a statement in their reporting that Sam Bankman-Fried gave, saying that he's not aware of any market manipulation and certainly never intended, that word coming up again, never intended manipulation. He said to the best of his knowledge, all transactions were for investment or for hedging at Alameda.
So I have a jurisdiction question, and you might not know the answer to this, I'm not sure, but this occurred to me as our Jen Schonberger was talking to Gary Gensler yesterday, which is, of course, FTX was domiciled in the Bahamas. That's where Sam Bankman-Fried and his team were located. It seems as though, as we talk about more regulation, whether it's necessary, et cetera, what we're describing, in theory, allegedly, would be against U.S. law if it was indeed a fraud. What's the jurisdiction then for the U.S.? I think, about 2% of the customers affected were U.S. based, but how does that all work?
Yeah, so the U.S. has broad authority and will use its jurisdictional authority anytime a U.S. customer is impacted.
So it's where the customers are. That's the relevant part here.
So the transactions that are isolated in the Bahamas and are with non-U.S. customers, non-U.S. entities, those would be outside of the jurisdiction of U.S. authorities. But anytime simply a transaction even crosses the border to the U.S., now you have a problem. So the U.S. authorities usually don't have too much of a problem finding some sort of nexus where they can have a jurisdictional hook.
And so for the people that have already started to file some of their class action suits against Sam Bankman-Fried, what recourse right now do they have to be able to continue to work through in these proceedings to try and hold them accountable?
Yeah, well, recourse if those customers, if those people who are filing lawsuits, if they want money as to make them whole, they very well may not get it, right? Because right now the bankruptcy proceeding is going to dictate everything that happens in terms of people being able to claw back, entities being able to claw back money. And look, there's such a big hole there that whether any of the customers that were holding cryptocurrencies will get their money back is a big question. Obviously, Sam Bankman-Fried has has repeatedly said, well, it shouldn't impact U.S. customers, that the U.S. entity in this whole scheme, that it should be able to make its customers whole. Now, that's yet to be seen. There's so much still to be worked out through the bankruptcy proceedings.
Yeah. Kevin O'Leary telling us earlier this week that he wants a full audit, and that's, of course, one millionaire's recourse versus the average person who invested in their recourse there. Thanks so much for breaking this down for us. Now, Finance's own Alexis Keenan. Everyone switching gears here. GameStop. They missed estimates in its latest quarter while reporting a year-over-year decrease in its cash and cash equivalents. Amid this downbeat earnings release, GameStop's CEO says the company is open to exploring acquisition opportunities. There you're taking a look at your screen of the actuals versus some of the estimates here, and we've been watching GME shares here, but most notably here, within this earnings release, but also the call thereafter. This is a company that's not taking any more questions. The call is very quick, and they just pretty much lay out the environment that they're in right now.
Right, it's a comedy of errors over at GameStop. Matt Furlong, CEO, another 8-minute conference call. 1 minute of that entire 8-minute conference call was them reading the safe harbor disclosure. Matt Furlong only spoke for about 7 minutes. And I have a story right now on the Yahoo Finance homepage that's really getting me dragged on Twitter. I really don't care, because the bottom line analysis here on GameStop, this is a company that has now, I think, broken a lot of promises to investors. You have sales down in pretty much all divisions. You have margins under pressure. And now you have a clear shift in tone by Furlong in his 7-minute conference call saying we are now cutting expenses. This was a company that was supposed to be investing for future growth in new areas. That it goes completely against what him and Ryan Cohen have been pitching to investors over the past year. A big change in tone, and I think a big red flag on this company.
I mean, it's very confusing why the stock would be up, but I guess that's nothing new, right?
It was down. It was down about 4.5 yesterday. So
I thought I saw a green on the screen. What was I looking at?
Well, it looked like pre-market. It is, in fact, up. So maybe the market likes.
Oh, but now it's down.
But maybe the market likes that they are cutting expenses. But even still, this company hemorrhaging cash. They're now in cash conservation mode. They're out there cutting expenses. I think trying to finally make a quarter for investors. And it's not a good look. Not a good look.
Yeah, definitely not a good.
On the call, they said that it's worth reiterating our goal is to achieve profitability in the near term. How? They're already looking at some of the inventory that they have. They also discussed that on the call to say how much of that they need to actually continue to work through. They said that they've strengthened their inventory position by divesting a small percentage of merchandise that was acquired. So anytime you hear a company divesting of its inventory, also trying to get back to profitability in the near term, by the way, with the backdrop of more entanglements or tie-ups in the M&A landscape that's taking place, and Microsoft and Activision Blizzard are eventually able to consummate that particular deal, that could be the nail in the coffin for a company in GameStop in terms of the retail environment versus how people are downloading games right now and just leveraging the cloud for that experience.
Yeah, and I just mentioned some of the Twitter reaction and to my story. I think one person just tweeted me who was watching this, cash flow positive, baby, eat it. Well, eat this. They generated $177 million in operating cash flow in the most recent quarter. Last year, they bled or lost $293 million. It doesn't matter. This is a company whose cash position is down year over year. This is a company still losing large sums of money in the quarter and year to date. This is a company really with no strategic vision to keep cash flow coming into its business over the next 5 years. So I get that they're passionate. I understand the GameStop faithful, but again, this was another terrible quarter by this company and another embarrassing earnings call.
Just to broaden it out a little bit and talk about meme stocks more broadly, and that was obviously such a mania, if you will. And just to show how they have done this year, if you take a look at the Yahoo Finance Interactive, here's a take a look at how some of these stocks closed yesterday and what they're doing in the pre-market. GameStop there in the middle on the bottom here as we watch that. I do want to flip it on over, though, and take a look at what we have seen year to date from these stocks, because it's pretty telling here, and I'm going to equal weight it so we can get more of a sense. So 1, 2, 3, 4, 5, 6, 7, 8 of them higher on the year. Now, this is, of course, highly subjective. It's what we consider to be meme stocks, and our Jared Blickery has consistently added new stocks to the board as they've kind of fallen into that category. But again, this just goes to show you. And some of these guys have lost almost all of their value if you look at how they have done year to date. There is a new survey that we're going to be digging more into in a moment that asked retail investors, have you invested in meme stocks before? GameStop, AMC, et cetera. Only 15.6% of them said yes. The vast majority of them said no. So I think it's interesting also to note that if you look at what has driven the volume in these companies, it hasn't been that many people necessarily that are driving it. It hasn't been that many individuals, and maybe even a lot of them have gotten out, perhaps.
Right. And the driving force behind the mimetic tenor has been how they can issue or how they can move forward with an effective short squeeze. And you look at the amount of shares or the float that was shorted in GameStop at the peak of when some of the meme stock traders or the Reddit retail trading frenzy had really taken place and initiated, it was over 100% of the shares that were shorted at that point in time. And so it means not only were they shorted once, but then twice over sometimes as well. And so for right now, the largest shorts in the market seem to be maxing out at about 45%. Bed Bath & Beyond, one of our favorites to talk about here as well, is within that ranks. And so all that considered, you're not looking at the same environment of short interest that's out there in the market for a mimetic type of tenor or trade or sentiment to really initiate around, well, unless it's a Bed Bath & Beyond, and even then you wouldn't still see the same type of squeeze that we had seen with GameStop or even with AMC.
Yeah, well, that same survey I mentioned that talked about whether retail investors are interested in memes also gives us some broader insight into what's going on, because retail investors don't necessarily seem to be fazed by the challenging market that we've seen this year. According to a new survey by Finamize, only 1% of retail traders plan to sell off their investments in the new year. Joining us now to discuss is Max Rofaga, Finamize CEO. They don't want to sell at a loss for some of them, right, Max? So I guess that's part of what's driving it. You know, Max, we talk a lot here about Wall Street strategists and what they think is going to happen in the new year. But obviously, retail investors are a large and growing part of the market as well. And the majority of the folks you surveyed, about 32%, said the stocks aren't going to bottom for another 6 months. What kind of insight and color besides that did you get on where things are going from here?
So I think as you touched on, I think the broad narrative has been around a very small subpopulation of retail investors who invested in these meme stocks. As we saw it in our own survey, only 15% actually invested in these meme stocks. If you look at the actual trading volume data, that lines up. Most recently, obviously, we saw Bed Bath & Beyond. I think roughly 10% of the trading volume actually came from retail investors. And so we're talking about a very small subpopulation that's been shaping the narrative. And what we're seeing now in the survey that we recently conducted with Finamize is that the vast majority are not day trading, but in fact are investing for the long term. As we talked about, only 1% are planning to sell off. The vast majority are taking a long-term view and are viewing this for what it is, which is just part of an economic cycle.
Max, 84% of those surveyed have never invested in a meme stock like a GameStop, I imagine we were just talking about. Why do you think that's the case?
I think it's because they understand that it's number one, it's just one stock. It's not diversified. I think number two, and this is now really coming to the forefront, is that people are really looking at fundamentals again. And I think perhaps over the last couple of months, there was a bit of an oversight, again, within a subpopulation of this. But the overall retail investor population is increasingly looking at fundamental research to assess whether to invest somewhere or whether not to invest.
What do you think they're seeing within the fundamentals for some of the individual stocks, specifically in tech, that they seem to be really excited about over the course of the next year? Some of the names like Apple, Microsoft, Google, Meta that have popped up in the survey.
Well, I think number one, there's a continuous belief that these large technology firms will continue to shape the business world and the broader society that we live in. I mean, if you look at someone like Warren Buffett, obviously heavily invested into the likes of an Apple. And so I think people are viewing what's happening currently as perhaps overcorrection in the market that will recover. Having said that, they also are looking to diversify again into other sectors. So going beyond tech, which, as you suggested, the survey says they continue to be bullish on. And they are also looking at other sectors like the energy sector, which they have a longer term thesis on. So I think at the end of the day, it's really just understanding what are we investing in, what is the thesis, and how can we more broadly diversify. I think that's been the theme over the last couple of months.
Max, it's also really interesting because so many of the people you surveyed are investing in individual stocks, specifically 72%, another 61% or so in index funds. And that struck me because people still think they can beat the market. And, some of them can, but it's really difficult to do.
Well, I think, as you say, most of them are, or rather put differently, the vast majority of them are in fact looking to diversify into index funds. But there is a certain school of thought that says actually, in a downturn, that is when you can perhaps beat the market. That is perhaps when an active fund manager, or in fact, if you have a specific insight or a specific view on the future and evolution of a specific company, that you might be able to, in fact, beat the market. But again, I think people are saying, let's diversify, let's get into index funds. And yes, we will continue to look at individual stocks. And, at the end of the day, there is also a certain element of enjoying researching stocks and investing into stocks that we cannot forget.
Well, we certainly enjoy researching and maybe not so much of the investing into stocks, but definitely doing the research and presenting some of that. FINMI CEO Max Verfaga, thanks so much for joining us here today. Some interesting insights there. Guys, coming up, why our next guest says that the inflation peak is behind us. We're going to speak to a strategist from UBS next. Welcome back to Yahoo Finance Live this morning, everyone. Weighing the odds. Futures are slightly in the green on this Thursday morning after 5 straight days of losses for the S&P. This as the market considers the likelihood of a downturn during an inflection period of change. Joining us with her insight, we've got Nadia Lovell, who is the Senior U.S. Equity Strategist over at UBS Global Wealth Management. Nadia, great to have you here with us today. First and foremost, when you think about this inflection, what are some of the characteristics that would really kind of have some outsized weight as we even go into 2023?
Thank you so much for having me. I mean, we're thinking about inflection not only from an inflation standpoint, but also from a growth standpoint. We do think the peak in inflation is behind us, but inflation is likely to remain elevated into the first half of next year. That also means from a growth standpoint, we think that growth is going to be inflecting downward in the first half of the year. We're likely to see a recession. As we know, the Fed has been on an aggressive path of hiking monetary policy and hiking interest rates, and we're going to feel the full effect of that into 2023. And so we're likely going to see an inflection in growth in the first half of the year into a recession, and then sort of a re-acceleration in growth as we head into 2024. That also means that's going to have an impact on corporations as well as the market. And so we think that this is a market that is going to continue to struggle into the first half of the year, and we're likely to continue to see a bear market.
Well, Nadia, you've been adding to the drumbeat that we've gotten of quite a lot of negativity, or at least a lot of caution, right, in this market. So given that, what do you do? I know that you guys are looking at defensives, which a lot of folks are looking at right now. At what point do you worry about trades like that getting too crowded because there is a lot of caution being expressed by investors right now?
We don't think that we're there yet, because we don't think that the earnings revisions that we need to see happen in the broader market, we think that expectations for growth are still too high. And so we think that that's going to come down in the first half of next year. And when we think about defensive, we're talking about sort of those more traditional defensive sectors. So consumer staples, people are going to still need essential products despite an economic slowdown. Also healthcare, there's still going to be a demand for drugs and healthcare services despite a slowdown. I would also put energy in that bucket. Now, energy is traditionally a more cyclical sector that's more sensitive to economic growth. But in this cycle, we just think that it's different. Russia's war in the Ukraine this year has really disrupted the energy market. And also, we've all seen all the news reports over the last couple of weeks around China and reopening of China. Remember, China is the second largest consumer of oil. And so as that economy reopens, it's going to put upward pressure on the oil prices, and that's going to help the energy sector. And so we would also put energy in sort of that more cyclical defensive bucket, if you will.
Nadia, you and the team write at length about this concept of the decade of transformation. What defines that, and how could the average investor invest in that?
Yeah, when you think about sort of a decade of transformation ahead, you also want to think about it not only from an energy standpoint in terms of clean energy and the move towards the energy transition, but you also want to think about it from a cybersecurity standpoint. And also, I think that this war that's happening in the Ukraine, we think that that is going to highlight the need for additional security and the transformation of security. So think about it also from a food security standpoint, and how do we get food in a safer and a more efficient way to a growing population.
We were just talking about why some retail investors might favor some tech names going into 2023. But as you think about the amount of spending that's still going to take place, the uncertain employment environment and what that headcount will actually look like at many of those companies, and we don't know when advertising revenue is still going to come back in full force, what would you be tracking most notably within tech?
I think we're continuing to watch enterprise spending. I mean, enterprise spending is being called into question in tech right now. We know that tech benefited quite a bit from the pandemic, and there was some pull forward in demand. We already know that there's weakness in the PC market. We already know that there's weakness in the smartphone market. But we're also now starting to see it, that deals are just taking longer within enterprise spending as companies really tighten the belt. So we want to continue to watch that. I think also, as we know, in sort of any sort of economic downturn, as companies rein in expenses, one of the first areas that they look to cut. And so we think that that's likely.
I think we're having some a little bit of a
when the economy.
Nadia, I think we're having some trouble with your connection, but really appreciate your insights. Very, very helpful as investors look towards next year. Nadia Lovell, Senior U.S. Equity Strategist at UBS Global Wealth Management. Thanks so much. We appreciate it. All right, coming up, Big Oil is looking to give away some cash. More on that next. We're just a few minutes away from the opening bell on Wall Street, but let's take a look at some hot ticker pages on Yahoo Finance. First up, ExxonMobil seeing action after the energy giant announced a $50 billion stock buyback plan through 2024 and raised its spending expectations to the top end of its guidance for the coming year at $23 to $25 billion. And guys, the headline here, of course, is that stock buyback, $50 billion is no small number, of course. But the other side of this is Exxon is saying it could double earnings and cash flow by 2027, despite the push to green energy in the U.S. and in many countries around the world. That is going to be a big target for them to hit.
Yeah, they've got to have a lot of confidence to do this right now, especially during a year where the stock has been up by about 65% over the past 52 weeks. And then year to date, of course, up handedly as the rest of the energy sector has been as well here. But for what we're watching for ExxonMobil more broadly in this shift, and it's not just Exxon, but Chevron, eventually there will be a point where they do have to invest some of that cash in some of the more sustainable promises that they've made to the general public at this point. But as of right now, this has been a heavy year for some of those gains that we've seen in the share price and being able to cash in on that too.
Well, they are spending on some of that, right? There's doing things like carbon capture. Remember, we talked to Rob Thummel of Tortoise earlier in the week who talked about that. But this is really, as he also pointed out, one of the main things that has been driving the share gains for many of these big oil companies. It hasn't been oil because oil's rolled over in the second half of the year, although it has been rising in recent days. It's that they have been growing these cash returns to shareholders, right? And not just that they have a high dividend yield, big share buybacks, it's that they keep increasing them. So that's exactly what ExxonMobil is doing once again. And one of the reasons that you still see investors flow towards these companies, even if they're not ticking the sort of ESG boxes that some investors want, although they are doing some of that activity on the margins.
I'll add, I would just be mindful because we are now, of course, we've seen oil prices come down. And I think you talked about it the other day, Julie, these oil stocks like Exxon, Chevron have still been hanging up there. But usually when you see that happen and you see companies announce these large stock buybacks, it's them saying, you know what, we may not see the same stock price appreciation next year as we did this year. In many cases, in my experience, that has often meant a top in a stock price. So just a little nugget to stick away.
Within this as well, they also announced some of their plans to increase lower emissions efforts, and that's going to be raised by about 15%. The timeline target to that, or 15% to roughly $17 billion, is the dollar figure, but the timeline for it to actually be appreciated is 2027 as well.
Yeah, so I guess, a little bit of this, a little bit of that. Well, it all adds up to the stock going higher. And we'll see if you're right, Saz, that this is a signal about it would be tough.
I'm rarely wrong.
It would be.
I'm rarely
wrong.
wrong.
Sure.
I mean, of course.
It would be tough to match the gains next year that energy stocks have had this year by any measure, right? There we got the opening bell on Wall Street on this Thursday morning here. AMN Healthcare is ringing the opening bell here this morning. And as we look to stocks here, as we get into December, things do start to slow down. Of course, you tend to get trading volume that's a little bit lower. You also tend to get sometimes wacky moves, right? Because you have people doing sort of end of year, what's called window dressing for their portfolios. So moving things around for the end of year balance sheet and tax reasons. All of that said, we're seeing a little bit of a bump up in stocks. So you're looking at me like you want to say something.
I'm just mystified. I'm on the GameStop ticker page, top ticker on our site, up slightly after a really ugly, disastrous quarter and a very short earnings call.
I am the shrug emoji.
I just want more tweets from these folks out there. That's all.
I'm sure.
I do.
Everyone send Saz. He
at
loves,
Brian Sazzi on Twitter.
He loves to hear from you, even when you're yelling at him. I don't know why, but anyway, Brad Smith is over at the Wi-Fi Interactive. Oh, you wanted to? Be careful what you wish for, my friend.
I was just asking you guys to come this way. I don't want any of the smoke from the Twitter thing out there. We're taking a look at the Dow Jones Industrial Average out of the gate here. I put this on a 2-day view so we can populate that chart for you. There, we're seeing that move higher out of the gate by about 0.4%. The Nasdaq Composite, we're seeing that move higher by about 0.5% here early in trade on the day, and then additionally the S&P 500, you've got that up by about 0.4%. Also want to take a look at some of the sector activity that we're seeing just after the opening cross, and we'll get back to some of those mean names in a hot second. But taking a look at the sector activity, wow, yeah, you got some Lake Red on the screen there. Wait a minute, that's a year-to-date view. Let's put this on intraday. There we go. That's looking a little more stable there. Okay, so some of the staples are moving lower here out of the gate this morning. It's down by about 0.25%. But energy, as we were just talking about Exxon a moment ago, you see that moving higher by about 2.25%. Overall, the S&P 500 we mentioned is higher by about 0.3%. And then lastly, taking a look at some of the meme names here on the day, just to give you a holistic view. We're relatively split, but it looks like we have just a few more gainers than laggards. We'll see where that continues to move forward as we move on throughout the rest of today's activity here. And wow, that's a huge move on Express that we're watching right now.
Yeah.
Yeah, we'll dive into that in a hot second.
We're going to dive into it right now because I'm so confused about what's going on there. It was plunging earlier. Now it's up by 59% here. Express soaring. And the company did report up. It's not
Express
working.
on over here. Welcome back.
Okay, it's reporting an 8% drop in sales in the third quarter, $30 million operating loss. Customer cost cutting hitting the clothing retailer hard. It's also announcing a joint venture with a company called WHP that has brands like Toys R Us and Anne Klein, Joe's Jeans. And as part of that joint venture, WHP is going to invest $235 million for a 60% ownership in the joint venture. Express is going to own 40% of that thing. I'm a little confused about exactly what this joint venture is.
Yes,
I know you've been looking at it,
full disclosure, this is something I need to look into a little bit more. It is a little bit of a complicated release because you do have two things coming here from Express. As you mentioned, Julie, a challenging quarter. I would say some challenging guidance from the company. Inventory not where it needs to be. Tim Baxter, who's been on with us many times, talking about his turnaround plan, calling out some misses in the women's side of the business. But this deal essentially makes WHP almost a 7.5% owner of Express. So it looks like they get a cash infusion and a new owner. But again, there's a lot more to unpack here. But I think it's this strategic decision by Tim and his management team to get a new investor here, get some cash, more cash into the business. That's why the stock is rising the way it is.
You know, for what we've discussed and continued to try and unpack with Express over the past 2 quarters now, it's really a question of what part of the market do they want to play in within retail. And of course, there's been a lot of the discounting that retail broadly has had to move forward. But for Express in the categories that they are competing within, it's hard to say that they would be a category leader. However, in some of the different areas that they are putting forward, some of the fashion, some of the apparel, this stuff feels good. I'm going to be real. As a customer, but at the same time, I go to them for the discounts, for the deals. I'm not prioritizing them at the high-end kind of purchase that I'm looking to move forward with. So they're going to have to continue to look at some of the inventory, heavy promotional environment that they're still going to be in, not just through the holiday season, but for an extended period of time. I just wonder what brands they think are going to grow out of this deal that would allow them to paint a different consumer sentiment picture as well.
Well, it's their own brand. It's what it sounds like, that they're just. So I'm looking at this a little bit more. So basically what they are going to have an omni-channel platform to drive accelerated long-term growth through the acquisition operation of a portfolio of brands. So I guess there will be multiple brands. However, they're also forming an intellectual property joint venture intended to scale the Express brand through new domestic category licensing and international expansion opportunities. I don't know that the brand as it is that well known in order to do that kind of thing. I mean, we also have some folks chiming in our Slack channel that the quality of Express is not necessarily strong. You know, you get what you pay for, right? To your point about you go there.
I think they improved the quality. It is a different,
but at that price point.
At the price point.
Yeah. I brought some $25 boots from Express over the summer. Off season, off cycle, bought the boots, $25. I am happy with the $25 boot purchase because it was from Express and because the quality held up for $25. But if I had to pay $50 for the boots, I wouldn't have gotten them.
Interesting.
And I wouldn't have been happy with it.
But you made a good point. It is a challenging industry out there. There's a lot of, the whole apparel industry is absolutely awash in inventory. We learned that from VF Corp this week when they reported. I mean, this is going to last. This issue is going to last well into the spring of next year.
They've had some interesting partnerships that they've moved forward with during the NIL period as well. They had some college football players that they partnered with, and we've seen that in the past, them prioritizing some of those sports partnerships because of the cuts of what they are making. But I think, with this strategic partnership, I mean, and the deal that they've made, what really comes forward to turn I don't want to say Ever Given, that sounds really mean, but what really comes forward to turn the boat around here?
That would imply a size that they do not have either, I think. Sorry. I mean,
Brutal.
Anyway.
Well, we're also taking a look at Rent the Runway here. This one actually really interesting on the day here, too. It's popping by about 26% this morning after the clothing rental service raised its full-year outlook and saw a 15% boost in subscribers from a year ago. I'm just upset that they still don't have men's.
Well, I'm going to take this and shovel it off to, this is the Julie Hyman portfolio, Rent the Runway and biotechs. Over to you.
What I will say that's interesting is that between Rent the Runway and Express, they have something in common. At $1.75, and what was it Express? At like $1.91?
Yeah.
If you are a retail investor and you've invested in meme stocks and you want to pick something up, that this was one of the Miles Udland rules for the meme stocks, under $10, right? Or a low per share price, which sort of psychologically says to people, oh, I can get this for not very much, you know,
But
kind of.
174 could still be overvalued.
Of course.
Of course.
Of course, yes. But I do think psychologically that's sometimes one of the things that drives these things, which is kind of interesting. Yes, I'm a not only someone who talks on TV about Rent the Runway, I'm also a client, right? I'm wearing a jacket rented from Rent the Runway right now. So I've been a longtime customer of the brand. There you see Rent the Runway and Express there. And so it is interesting to see, though, because I don't know if I'm an island, if there's a lot of other people who are signing on to the platform, but seeing that number of active subscribers up 15% year over year is interesting. There are more people at the office, so that likely drives some of this. There are people who didn't go out to holiday parties last year, right? There are more holiday parties this year compared with last year again. So it makes sense. The other thing is that the CEO, Jennifer Hyman,
no relation,
did say that they are at the end of the restructuring that they had been doing. So all of these companies that we're now talking about that are cutting expenses, that are restructuring, Rent the Runway did that a little bit earlier, and so now is at a different phase than some other startups that we talked about.
Right, and that restructuring took out, I'm looking at a good note from the team at Jefferies, that restructuring took out almost $30 million of annual cost out of the business at a time where their subscribers, at least in this quarter, were up 15%. So right now, that might get them to another quarter of adjusted operating profits, which they have delivered, I think 2 quarters in a row. So maybe that continues into next year.
Yeah, you saw that play through in some of the gross margins as well. Gross margin, 41%. You compare that to 33% in the comparable period last year. And then additionally here, just the net loss as a percentage of revenue, that was 46%. You compare that to 148% in the comparable quarter of last year. So year over year, massive improvement, different environment, people going back into some of the social constructs and events as well.
One other thing that Express and Rent the Runway have in common, both of them are down enormously year to date. Rent the Runway is down more than 70%, Express is down by nearly 60%. So it's not like everything is hunky-dory, right? It's just this quarter maybe is an inflection, but we'll see what happens.
Getting a lot of pushback from the producers in the Slack channel on the quality over at Express. I happen to think the quality is greatly improved. I bought a turtleneck from there.
These pants are from Express.
Yeah, I don't agree. I think some of these folks haven't shopped Express in 10 years.
Oh, well, they got to come join me. Come to Brooklyn with me. All right, guys, coming up, Yahoo Finance's Jared Blickery is going to break down the latest market action as we're 9 minutes into today's trading session. That's coming up next. Good morning. Welcome back to Yahoo Finance Live, everyone. We are about 12 minutes inside of today's trading activity. Let's get on over to Jared Blickery, who's standing by at the Wi-Fi Interactive. Jared.
Yes, Brad, standing on some modest gains for the day. Dow up about half a percentage point, but let's take a look at where we are in the week. 4 days, we're down about 2%. And if you look at the Nasdaq, which is up just about barely today, that is down 4%, so almost twice that. And it just goes to show you the continued outperformance by the Dow, even though it is in the red, it's by a little bit less amount. That continues into this week. And all eyes now really shifting to the Fed announcement that we have next week, along with that CPI print. That's going to be key for determining future price action. For today, we want to concentrate on what's happening in the sectors. Energy is in the forefront. That's up over 1%, followed by industrials, materials, real estate, tech. All of those outperforming. Communication services, which houses some of the stocks like Meta, as well as Verizon and Netflix, for instance, that is down by 1/3%. Utilities down 18 basis points. I want to go to the S&P 500 and show you what's been happening. I wrote about this in the morning brief today. We did have that big spike up last week above the 200-day moving average. Got to close above, but then 2 days later, we're just sinking back below it. And so with those kinds of false breaks to the upside, I was taking a look at what happens historically. So we've come off that mark a little bit and just want to show you what the seasonal tailwinds look like. This has to do with the Santa Claus effect. Technically, this is only covering the last 5 trading days of the year, as well as the first 2, but this is coming from the market ear over and quoting the equity clock. How is that Santa Claus rally doing? According to Bespoke, this is the worst first week of December, down 4.4% for the Nasdaq since 1975, so not off to the best start right now. If there is any Santa pattern, it should be kicking in soon, although returns aren't overly impressive. Nasdaq and S&P 500 seasonality charts over the last 20 years. A little bit hard to see here. This is the S&P 500 over the 12 calendar months. Basically, we start going like up to the upside in March, April, and right now we are at the point where seasonality should be kicking in. So if it's going to happen, should happen soon. But without further ado, I don't think we really have a lot to talk about until that big CPI print next week, guys.
All right, we will continue to watch out for Santa. Jared Blickery, really good stuff. Appreciate it. Okay, it hasn't just been a bruising year for inflation in the United States, but also one for many developing countries around the world. In fact, some countries such as Zimbabwe and Lebanon have seen triple-digit inflation from, as you can see in that chart or graphing from Visual Capital. Zimbabwe inflation up 269% year over year, going back to October. That is a very, very big gain. All right, coming up, it was a big quarter for soup sales over at Campbell's Soup. CEO Mark Klaus joins us next for a chat. Campbell's soup stock is still warm after a hot quarter. The company beat on earnings and revenue and boosted its guidance as it passed higher costs along to shoppers and drove product innovation in soup and goldfish crackers. The man himself, Campbell's Soup CEO Mark Klaus, joins us now. Mark, always great to get some time with you here right as we get into the peak of soup season. And you had a pretty good quarter in U.S. soups. Why do you think that's the case?
Well, I think, Brian, first of all, great to be on the show. Thanks for having me. I think in the moment that we're in right now, the soup business really matches both the demand for consumers and the value that they're looking for. And as we've watched consumers navigate through tough inflation, a backdrop of a tougher economic environment, I think soup in many ways checks a lot of boxes for consumers right now. It's a product that's very versatile, whether you're preparing your Thanksgiving dinner or whether it's something that you're using for a quick lunch. And I think that has demonstrated a lot of resilience in this time. And I also think it's a bit of culmination of all the work that we've been doing the last several years to rejuvenate this brand and business by bringing, as you said, a lot of innovation as well as great marketing. Our Chunky business is an example. Really great. Best new item in soup last year was our spicy line of Chunky, really targeting younger consumers. And we paired that with great marketing on things like EA Madden, which really would not have initially thought of Chunky in the world of gaming, but it's proven to be a great bridge for younger consumers and younger targets. And then a full line of better for you products with Well Yes and Pacific that really rounds out that portfolio. So I think, kind of the culmination of a lot of good work, but in a good moment for the category as well.
Mark, I've told you this before. I've tried that spicy, chunky soup, and it has sizzled my tongue. I mean, it is a good new product by the Campbell team. I have to give credit where credit is due. But the moment that we are in, like you just mentioned, do you think consumers are just cutting back on making larger meals because they've been hit with so much inflation that they now view a can of soup as the only meal that they can possibly afford?
Well, I think it's really more about making your dollars stretch. And, one of the things that we talked a little bit about yesterday is 80% of meals right now are being prepared in home. And in what we're hearing and understanding from consumers is they don't really want to make trade-offs, but they want to understand how to do this in a more economic way. And so when you look at an average meal prepared with our products, so think condensed soup, think broth, even Prego pasta sauce. As you're putting together a dinner for your family, average, even with the inflation we've experienced, about $2 a serving. And that's versus away from home, about $20. And even if you're in the grocery, we're seeing a lot of migration from higher cost categories or segments like frozen, for example, into the shelf stable space, both for prepared meals, but also for, as you point out, quick lunches. I think one of the things that's really worked well on Chunky is the protein content and the messaging around kind of the fulfillment of lunch with something that's quick and easy. So I don't know that I see it shrinking necessarily, but I do think value is a big driver right now.
Let's pick apart some of your ingredient basket here. So you have, I'll put tin. You use obviously tin to put the soup in. You have tomatoes. You have vegetables. Within this ingredient list or this cost of goods sold, is inflation coming down, or are we beyond the worst?
Well, I think as you think about the year, and if you listened to us yesterday, it was a pretty significant number where inflation in the first quarter for us was 18%. And many of the elements that you're describing are part of that. I do think as you manage through the balance of the year, the incremental nature of inflation will begin to moderate. But remember, you're going to begin to lap big increases in inflation a year ago. And so that's part of what's helping those comparisons as you move through the year. Interestingly enough, I think what you're going to be experiencing in most businesses is some areas that are coming down and some areas that are still demonstrating incremental inflation. We talked about yesterday, as surgical and targeted as this will be, a bit more pricing needed to match a few places where we're still seeing inflation creeping up. But at the end of the day, I think collectively or in total, you'll see a moderation of the amount of incremental impact from inflation without it necessarily turning yet into something like deflation or overall costs going down.
And I know, Mark, the Goldfish brand has been very hot for you, really, the past few years. In terms of this year, how much in sales will that brand do this year? And then next year, what else do you have coming on that front?
Well, it represents a significant part. It's our biggest brand on the snack side by far, and it is one that has, just as you said, been doing tremendously well. And really at the heart of that strategy, and this was, I think, just an excellent job by our marketing team, and really understanding that the Goldfish brand is in almost every home, but really had been targeted primarily to the kids. And the strategy over the last couple of years has been to broaden that range of household members because everyone sneaks a handful of it, but we want them really excited about the products that are coming in and bringing the full range. And so you go from a Frank's Red Hot, which was one of our really successful in and outs that we're going to be bringing back in limited quantities due to popular demand, but also down to the basic product, or even things like the Wakanda Forever Black Panther partnership that we have right now, where we're still very focused on the kids in the household, but want to bring that full range. And then innovation like megabytes and some of the pack sizes that really help match consumers' lifestyles has been really the key ingredient to success there. So a big brand, iconic brand, but one that we've really kind of been able to rejuvenate and bring some new life to through broadening it across further consumers.
Well, I know I've been an avid consumer of all things Goldfish for many years. Campbell Soup CEO Mark Clouse, thanks for giving us some time this morning. Really appreciate it. Happy holidays to you.
Yeah, thanks, Brian. You as well.
Thanks so much. All right, coming up, some high drama in the C-suite over at Salesforce. We're back with a hot take on this next.
It's been a rough few weeks at Salesforce after the departure of 3 top-level executives at the company, and Wall Street's not taking the news well. Shares saw their worst day since 2020 this week, and they're taking a hit this morning after a downgrade from investment firm Baird. to the drama, I should say, caught the attention of Mr. Sasi, and that's where we find his take today. You followed this company pretty closely.
Yeah, it's, first of all, I have to give a hat tip to Emily Glazer over at the Wall Street Journal. They reported some tensions internally over at Salesforce between now outgoing co-CEO Brett Taylor and founder Mark Benioff. Just my interactions with both of them, they're two very distinctly different people. I think Brett has been very, focused on operational execution and talking to CEOs a lot outside of the company. Mark Benioff is Mark Benioff. He's a big presence, but I think he wanted to maybe pull back a little bit here and start focusing on other efforts and his other various endeavors. But again, here are a couple problems here I think that is ultimately hurting Salesforce that at some point they're going to have to address. You have that C-suite exodus. Not only is Taylor leaving, you also have Slack founder Stuart Butterfield. He recently said he was leaving. About a week and a half ago, you had Tableau's CEO leave as well. So there's also been a couple other people leave at Slack in addition to. And this comes at a time where the company is really trying to focus on improving its operating margins. And that's also happening while sales growth is slowing. And again, you have this leadership uncertainty, not just within the CEOs of each of some of these brands, but also that next level or third level down inside of Salesforce. And to that end, we just recently caught up with Brent Thill. He's been covering Salesforce for a long while. Take a listen to his comments on what he thinks is bugging or really weighing on Salesforce shares here.
Again, I have huge admiration for Mark, but I think investors right now have lost confidence in his ability to get control of the expenses and actually drive this through this recession. And so, again, that's investor sentiment.
I was thinking back over to Dreamforce. That, of course, is the big Salesforce annual conference. And I asked Mark about the focus on operating profits and operating margins. They have been lagging a lot of peers in the industry, and it reflects a lot of the acquisitions the company's made over the past 5 years. Slack, Tableau, you name it, MuleSoft. And Mark said, I don't think the market appreciates how much we're focused on operating margins. And to that point, here's my take. Mark's going to have to prove that this company can get its operating margins up next year, and they can do so in a big way. They have the brands. They have the scale, they have the market share, and there I am with Mark Benioff, in those clouds, wanting to see them do well. I mean, this is a good company doing a lot of good, interesting things on the tech front, and they do have a good opportunity to bring those margins up.
I think what Salesforce did well very early on was making CRM and SaaS sexy. It was a user interface that people would rather spend mass amount of times in if you put that up against Oracle or SAP. But that was now 10 years ago. And so now for the disruption that they've been able to do, the acquisitions that they've been able to strategically move forward with, and now that next leg of growth that they're trying to initiate, what is the next reinvention for that user experience that's going to really upcycle that next wave of customers that are going to hop into the ecosystem?
Well, on the positive side, I think they have successfully integrated Slack with Tableau and MuleSoft and Salesforce. All these products are now being sold in one uniform way. That's good. And there is a lot of innovation coming on a Slack and a MuleSoft and Tableau. But again, they're going to have to drive a lot more of it and perhaps hold off on making that next big acquisition, even though valuations for a lot of companies that they are eyeing have come down considerably. It is really, I think, next year about execution, improving margins in all of those businesses.
All right.
Well, I want to get you some quick breaking news now on the COVID-19 front. The Food and Drug Administration has authorized COVID-19 shots that target the Omicron variant for children as young as 6 months old. We're going to bring you more updates on that news as we do get them. And coming up, why our next guest says productivity is the missing piece for the labor market. We'll speak with ADP's Neil Richardson. That's next.
Welcome back to Yahoo Finance. I'm Brian Sozzi here with Julie Hyman and Brad Smith. Some calm has returned to markets, at least for right now. We're seeing all three major indices, I believe, slightly in the green at this moment. The Dow leading the way up 251 points. Now here's what's on tap for us this hour. Crypto's cracks. We'll sift through the crypto rubble for a few winners post FTX meltdown with a top Bernstein analyst. And the outlook for jobs. With layoff announcements picking up, we'll dive into the job market and how it may shape up in 2023. And big quarter for pizza. Convenience store chain Casey's is fresh off a strong quarter. We'll chat with the company's CEO. Brad, over to you.
All right, got some gains to relish, at least in the early moments of trading here on the day. You've got the Dow up, as you mentioned, a little more than 250 points right now, 0.75% higher here intraday. But look, of course, at that broader trend that we're trying to break out of here. We'll see exactly where this continues to hold some steam as of right now, but again, up 0.75% there. Nasdaq Composite, that's up by about 1%, 117 points to the upside there. S&P 500, you're seeing fractional gains there to the tune of about 0.8% here. Also, let's take a look at the Nasdaq 100 just to see where we've got some outliers here on the day. Amazon is up by about 2.3% on today's activity. You also have some interesting activity in the form of Pinduoduo. That's up by about 4.7%. And it looks like some of the other Asia-related stocks, JD.com, also up by about 3.4%. And then also want to dive in on Tesla here very briefly, because that has been on a different kind of move over the past 4 days here. We'll see if we can break that trend. Over the past 4 days, down 10%. Right now, flat just barely to the downside. We'll see if that can move into positive territory as we're seeing the major averages also move higher as well right now. And switching gears, employee wages were on the rise in November to counteract the shortage in worker supply. But our next guest says that one thing is missing from the labor market. That's productivity. ADP chief economist Nela Richardson joins us now. Are we not as productive as we should be, Nela? I mean, I think we're doing pretty good, but perhaps there's something else at play more broadly in this employment situation.
So my next comments have nothing to do with your personal productivity.
Thank you so
I'm sure
much.
you are more productive.
I'm going to put that in my yearly review.
But as a country, we are actually less productive this year than we were last year. Americans are working more and producing less. And that is the fly in the ointment of the labor market, right? The way that wages go up for good reasons is that we're all getting more productive, more efficient. That makes companies more profitable. That increases wages. But that's not what we're seeing here and now. We're seeing wages go up because of labor shortages and the fact that companies are competing with each other for headcount. So productivity and the missing element of productivity makes a very strong labor market very hollow.
So Nela, it's Julie here. It's good to see you. Why is this still happening then? Why aren't we getting, like, what's the missing piece here?
You know, I have that same question. I really do. Because at the same time that we're seeing productivity decline, and this is not just a pandemic story, this has been happening for the past decade, we're also seeing the advent of all this technology. You have AI, you have chat boxes, you have all kinds of labor-saving, labor-enhancing technology. The question is, how do you get mass adoption of that technology in a way that makes workers more efficient? The second issue is the fact that some of this labor shortage is really a skills shortage. So it's about training up the workers in order to really leverage the technology in the right way.
Neil, we had some economists talk to us recently about a job market slowdown going into next year. How significant do you think that would be?
It's going to be hard to tell. And I know that's not the answer that maybe you wanted, but we're at, 50-year lows in terms of the unemployment rate. We're still seeing really robust hiring in customer-facing industries like leisure and hospitality, restaurants and bars, healthcare. And so right now, the labor market doesn't look like it's on the verge of a recession. In fact, it looks like a market that still needs people to come off the sidelines. Remember, labor force participation rate is still more than a percentage point down from where it was in 2019. We're still in need of workers, and it looks like companies are still set to hire in 2023.
So what type of fluctuation might we see in wages? I mean, even in the latest ADP private payrolls report, we saw that move higher by a little over 7%.
Right, 7.6%. Yeah, what we're seeing is that we've seen a tremendous amount of wage growth. We're not seeing a huge acceleration, but Wages are really topping out. They're staying at an elevated level, but that growth isn't decelerating. You saw that in the November jobs report put out by the BLS as well, 5.1% year over year average hourly earnings growth. So in both of these indicators, you're seeing wages go up and stay at higher levels instead of coming back down.
Neela, what's going to happen to purchasing power going into 2023, right? Even with those wage gains, purchasing power has not been fantastic because inflation's been rising at a faster rate. So how does that dynamic look next year?
That's the rub of the productivity that we just talked about. So we've seen all this wage growth, but it's not keeping pace with inflation. And for the typical U.S. worker, what it means is that your wages are not keeping up with price increases. So the important part of the Fed's next steps continues to be getting inflation down so that workers can actually feel the benefit of wage growth. Right now, they're not.
One thing that we did see as well within kind of this hybrid work environment was for people who were able to see a better wage, looking for as well better living conditions, a better area as well. Do you believe that that's still going to be the case in order to offset some of the stickiness of inflation and some of the necessities that people are paying for, whether that be on the housing front or just other basics? Do you believe that we're still going to see people moving at the same rate or migrating just to make sure that their dollar stretches further?
It's funny because there's so many more options in the labor market now. It used to be that you would have to pick up and move for a better paying job or a better opportunity. That's not necessarily the case anymore. While remote work is a bit on the decline from the peak of the pandemic, we're still seeing jobs that are being offered to be done in various locations. And so workers have more options now. Even a hybrid schedule can change where people live because it means you don't have to pay those commuting costs every single day. So that is something that actually is an advantage to workers going into next year, the widespread adoption of remote and hybrid work that wasn't part of any previous recession or downturn that we've been able to experience.
Neela, it's always great to see you and catch up with you. Neela Richardson of ADP. Thanks so much.
Thanks for having me.
Average rent prices in the U.S. continue to fall in the month of November as the housing market enters a cooling off period. Yahoo Finance's Danny Romero is here with the details. I guess it's not true everywhere, but yes, in general, we are seeing those prices come down.
Yes, across the country, yes. Nationally, we have seen rent prices come down for the past 3 months consecutively, according to data from RealPage. And this is the largest monthly cut since 2010, setting aside the pandemic-related months. And this dip usually happens during this time of year. However, some housing economists say that this is just not a seasonality type of thing. He said the biggest factor weighing on rents right now is the lack of new household formation. Here's a quote from Jay Parsons that says, head of economics and industry for RealPage, that says, inflation and economic uncertainty are having a freezing effect on major housing decisions. When people are uncertain, human nature is to go into that wait and see mode. New housing demand is dependent on household formation, which drove the 2021 housing surge, but appears to have frozen earlier this year. So that gives you really good context of why renters are sitting on the sidelines. Also, new leasing demand has tumbled in November, and there's a lot of these destination hotspots have also been feeling the pullback from renters as well. It's something that economists say that they haven't seen ever during a period of really solid job gains, and we're on track to end the year in the weakest net apartment demand since 2009.
Wow. So despite the national average falling, New York City average prices, they're still up, some 19% here. So where are we really seeing some of that kind of disjointing, especially from last year, and why is that still so elevated?
Well, New York is a totally different ballgame.
Yeah.
So if we're looking at New York, that's a totally different thing. In New York City, the average monthly payment is around $3,300. That's according to data from Street Easy. But there's some signs of easing. Some landlords are slashing those leasing prices. Data from Street Easy shows that 22.3% of New York City rentals on the market had a discount by landlords in November. That's up from 12.5% in last year. So the reason for these recent discounts is the fact that landlords could be resetting their expectations after really high demand that they saw in the spring and in the summer months. So there could be some silver lining per se here in New York City, but there's a lot more that will really see that meaningful decline.
Brad trying to spot his apartment building.
Actually,
in the
one of
video
those
there.
I saw you on there.
It was a shot of the building across the street from me.
Oh.
Look at you. There we go. Danny Romero, thanks so much. All right, consumers aren't viewing their can of beer as a discretionary purchase, at least beer out of Molson Coors. Evercore ISI met Molson Coors CEO Gavin Hattersley this week and came away with the view that beer demand is resilient year to date. Hattersley reportedly told Evercore ISI that demand for Miller Lite and Coors Light remains healthy in the current quarter. The investment bank rates Molson Coors at an outperform rating. Coming up, a former Theranos exec is headed to a cell. Julia's back with that and more top headlines next.
Some other headlines we're watching right now. Russia has freed WNBA star Brittany Griner from Russia's penal colony. That's part of a prisoner swap with former arms dealer Victor Bout, also known as the Merchant of Death, being released. President Biden had comments on the exchange earlier.
She wrote to me back in July. She didn't ask for special treatment, even though we've been working on a release from the day one. She requested a simple quote, "Please don't forget about me and the other American detainees. Please do all you can to bring us home."
And you saw there Griner's wife, Sherelle, along with the president. Griner's expected to arrive back in the U.S. in the next 24 hours. Meanwhile, American Paul Whelan, who has been serving a 16-year sentence in Russia after he was accused of espionage, he does remain detained. Biden said that Russia is, quote, illegitimately treating Whelan's case differently and that his release was not an option at this time. Theranos' former chief operating officer Ramesh Sunny Balwani was sentenced to nearly 13 years in prison by California's federal court yesterday for defrauding investors and patients. He was, of course, also a mentor and ex-boyfriend to CEO Elizabeth Holmes, who received over 11 years in prison. Prosecutors were looking for a 15-year sentence for Balwani, given his significant oversight of the company. During the sentencing, attorneys for Balwani tried to pin the blame on Holmes, telling the court judge she made the decisions. That conflicted with an earlier message to Holmes where he said, "I am responsible for everything at Theranos." The state of Indiana is suing TikTok. There are 2 lawsuits. The first accuses TikTok of targeting young teens with adult content and cites a study linking heavy use of the platform to mental disorders. A second suit alleges that China has the ability to spy on and blackmail users to serve its national security and economic interests. Texas and other states have already moved to ban the app on government devices. TikTok has not commented on the litigation, but said the safety of its community is a top priority. And it said it's confident that it will satisfy all reasonable U.S. national security concerns as part of its ongoing negotiations. Microsoft, Amazon, Google, and Oracle all received cloud computing contracts from the Pentagon yesterday. Those contracts for the 4 companies could reach a combined total of $9 billion through 2028. Last year, the Pentagon asked all of the companies for bids, but decided that only Amazon and Microsoft could meet its cloud needs. This time around, all of the players received deals in line with the U.S. Defense Department's efforts to rely on multiple cloud providers. The decision was a win in particular for Oracle, which analysts don't see necessarily in the top tier of cloud service providers. Saz?
The cost of Disney Plus is headed higher as the media giant looks to stem losses for its streaming business. Yahoo Finance media reporter Ali Canal is here with the details. Ali, the price is going up, and now it's, what, over $10?
Yeah, so if you want the ad-free version of Disney Plus, you're now going to have to pay $10.99. The ad-supported version is going to be $7.99. And we're seeing this at a time when a lot of streaming companies, they're hiking their prices. We've spoken to a few media executives that said if you're not seeing price hikes now, you will be very soon. Paramount Global CEO Bob Bakish being one of those. But you're taking a look at your screen now on all the varying prices. We had Netflix roll out their ad-supported tier last month, $6.99. Pretty competitively priced there. It'll be interesting to see how many people trade down to the ad-supported versions. There was a new study by Kantar Research that shows 1 in every 4 Disney Plus users will likely trade down to that ad-supported version. So that translates to roughly 46 million out of the whole user base of Disney Plus, which is currently 164 million. So that'll be something to track in the quarters to come. But overall, this is a play to add to profitability when at a time all these media companies are bleeding money.
Is it clear from the Disney strategy what content will be on that ad-supported tier versus what we saw with Netflix, where it wasn't clear what content people would have access to with that ad-supported?
Yeah, and Netflix is still dealing with that due to various licensing restrictions. Ted Sarandos said that 10% of content is not available on that ad-supported service. It's a bit different for Disney because they own the majority of their content. They really lean heavily on Star Wars, on Andor. Saz, I know you're a really big fan of She-Hulk, so
yes,
that's all going to be available on ad-supported. But in terms of Netflix, yes, that's something they're going to have to figure out down the line. Ted Sarandos did say that's a number that they're looking to hopefully bring up over time, but it's going to take a little bit. So a few downside risks there if you're going on ad-supported. And another thing for both Disney and Netflix is you can't download shows or movies if you have ad-supported due to those technical complexities. So another thing to watch.
All right, just needed to make sure I'd still have access to some of that Buzz Lightyear content as well. Guys, thanks so much, Alec Now, breaking that down, Yahoo Finance's Zone. Coming up, everyone, how investors should be viewing crypto following the collapse of FTX. We're going to discuss next. The latest crypto collapses, scandals, and bankruptcies are weighing heavily on digital assets as investors and traders alike lose trust in the falling tokens and the exchanges supplying them. So, should crypto still have a place in your portfolio? 401 Financial's principal and founder, Tyrone Ross, joins us now to weigh in. Tyrone, great to have you here with us today. First and foremost, I think people just want to know the answer to that. How should investors view crypto right now? Give us your perspective.
I think the key word, you said it, is investors. Those that are investors in the space and that understand it should have a very, very long-term view. Obviously, they should have a very high tolerance for risk. They should understand the volatility. But I think one thing that's important here is for anyone that is involved in this space right now, there's just something called a terms of service agreement that you sign with any of these companies. Try reading that. Even the best investors in the world do that.
And so, Tyrone, it's Julie here. It's good to have you. Are you recommending to folks that they get into crypto right now, or are you sort of letting them take the lead if they come to you and express interest?
Yeah, so I'm a bad proxy because I'm a self-proclaimed crypto hippie. The folks that come to me already own it. So I think it's just providing some guidelines around it and then getting them to diversify away from it so much. But those that are coming now, I think it's very simple of just having a conversation of taking them back to square one. You stick to the conversation around Bitcoin and Ethereum and some of the potential investment cases there if it makes sense for them. But outside of that, I think everything else is off the table right now.
What type of guidelines do you recommend?
So I call them a core four, right? You have an investor policy statement, right? If you're an advisor or just someone in general, you could have that is just some general rules around your investing principles and policies that you're going to follow personally. The second is your risk tolerance. If you can't stomach a lot of risk, this isn't for you. But again, the ability to identify risk, manage that risk, and diversify away from it. And then the other one is just your financial plan. What are your goals? If you have short-term goals, crypto probably isn't for you. Have long-term goals, a long-term strategy, and something that you feel like this is core part of you helping you achieve those goals, fantastic. If not, don't touch it. And then the last part now, which is not necessarily an issue now, but it will become a big issue, is estate planning around crypto assets. Because again, if something happens to you, my mother still calls Bitcoin a big nickel. So if I can't get my family and friends to understand that, it makes the estate planning part of it very difficult.
Let's talk about tax planning as well. For a lot of hodlers or even holders of crypto, they're going to have to decide, whether they decide to hold on to or going into the next year or sell it prior to the next year. There's still a massive loss that many probably are going to have to report for their taxes. What is the best way to go about doing that?
Again, I think to get educated, if we're just sticking with Bitcoin and Ethereum, it's considered property, right? As of right now, there's no wash sale rule, meaning that you can sell your Bitcoin and you can buy it right back. So you can take that loss. In stocks, obviously, it's not like that. You have to wait 30 days or buy, something that is similar. But those are key components of folks just understanding the basics here of what you can do. So I know you hear a lot of proponents of dollar cost averaging into the space, but a lot of people really still don't know there is no wash sale rule. You can sell, you can buy back, you can harvest those losses. This is exactly why you should get educated in space. Speak to folks that have some traditional finance experience, because some of the old rules still do apply here.
Tyrone, I have to ask, given that everything that's happened, including, FTX aside, just the price action, right? What still gives you confidence in crypto, even over the longer term?
Well, I don't make any, bones of the fact that I'm very bullish, but I'm on the ground floor building a company myself. I speak to a lot of the founders and folks that are really building the picks and shovel infrastructure plays. But my personal reason is this, and if there's a camera somewhere, zoom in right here. Crypto, right, has one inarguable use case. Every day that the Bitcoin blockchain survives, financial access is provided to billions globally. That has got lost in all this FTX, SBF nonsense. It is inarguable. If you look at the studies, even here in the US, those that make $50,000 or less, 12% of those people, this is from a federal government study, 12% of those use crypto to transact. As we sit here right now, we still don't have a real-time payment system. Right? Japan has had it since the 70s. They're saying we're going to get Fed now. So I'll end by saying this. If crypto or Bitcoin or blockchain or all these different marketing terms that folks are using, if it did nothing else, it shined this bright light in the corner that said, hey, the existing financial system isn't fair, equitable, or inclusive. Every day that Bitcoin survives, that changes. So to me, that is the biggest part of it. And I think as the use cases and we bring more people into the space, if they can transact cheaply and quickly, even if it just means we reintroduce traditional finance to a better way, to me, that is worth every dollar that goes into it.
Tyrone, as someone who's bullish on Bitcoin or cryptocurrency more broadly, do you believe that the comments that we've heard from Sam Bankman-Fried thus far have been authentic? And if one person can shatter the trust in cryptocurrency, what does that say more broadly about adoption internationally or institutionally?
I will say this. You should believe nothing that comes out of his mouth. I personally am very disappointed that he is continuing to be given a platform to speak at all. And then I think, yes, you are exactly right. If one person could be anointed to be the face of what we are doing, that's a problem. And it goes against the whole ethos of what this is about. But he was anointed and appointed. And you won't find anybody before this in the space that didn't really think that he was like the poster child, myself included. But ultimately, if someone shows their card to just be a horrible human being and have lack of respect for humanity and people, I don't care what industry that is, that person needs to be removed and they should have never been put there in the first place. But that is not an indictment on the technology and the people that are working very hard to build this technology and bring it to millions of people. And that should not be lost because he's just a terrible human being.
Tyrone Ross, principal and founder of 401 Financial. Really appreciate the insights this morning. Thanks so much.
So much for having me. I appreciate it. Of course.
Coming up, we'll look at a few winners and losers in the beat up crypto patch. That chat is next. It's been a tough year for cryptocurrencies, to say the very least, as the wreckage of FTX clouds the once bright spots of the crypto industry. Here to break down the winners and losers from the weakest links is Gautam Chugani, Bernstein Global Digital Assets Managing Director and Senior Analyst. Good morning to you. I think we right now have a general sense on winners and losers. Let's look out to next year. Who do you think will be the biggest winners and why?
Yeah, I think overall, the way the space is moving, given what's happened, particularly in the space, which was more sort of outside regulation, we essentially see a large spate of winners being in the regulated space. So overall, we think this space is moving towards more institutionalization. I think that sounds a bit odd to say now the environment, but as we see institutional investors come in the space, we do think that the winners are going to be, across segments, whether it's exchanges, whether it's on the custody side, or whether in terms of broker dealers. We're going to see significant players who are on the right side of the regulation as sort of regulation comes in to kind of emerge as winners.
Yeah, but that regulation would require companies to be either headquartered here or have at least enough of their assets that are held here in the U.S. as well and operating under laws that govern exactly where they can engage with consumers and how they themselves need to report. We haven't seen that thus far. So when do you expect that we will actually see companies like FTX want to come forward and want to kind of be part of that regulation, not just because they have a voice in framing it?
Yeah, so I think the space where we think regulation is going to come in significantly is going to be around what we call centralized finance, which is essentially the centralized players, whether they're exchanges, custodians, or broker dealers. I think that's the space where we do think legislation is going to come in. As that happens, we will see players kind of come in. I think as regulation stands now, most exchanges are kind of fall within the current regulatory framework. But over a period of time, what's happened is that most of these businesses have got commingled. So if you see a few broker dealers, they also custodian, they also do broker deal, broking. As I think regulation comes in and sort of there is separation of functions, lack of regulation around commingling of funds and commingling of operations, which could have conflicts of interest, you will see sort of these players sort of get absorbed within that regulatory framework. So over a period of time, I think the CeFi or the centralized part of crypto will start to resemble very much like existing institutional markets. What we are seeing is obviously a period of flux now, and the current accident that's happened sort of makes it makes the environment hard to imagine what's coming. But we do think that overall individual players within this space will kind of fall within, at least in the regulatory framework, at least in the US. And I think as US does that, you'll see that kind of regulation spread amongst the broader, at least the established markets, and we see some of that replicated across markets as well. So I think to kind of summarize, we say we will see significant business move from offshore to onshore. And that is obviously part of the regulation and the institutionalization.
Gautam, it's Julie here. I want to ask about Binance in particular, because obviously that's a company who has a lot of offshore operations. And it's also one where, maybe has gained some market share as a result of what has happened. But how do investors know that it's okay? Like, how do investors know anything is okay anymore, right, in this space, given what has happened?
Yeah, I think Binance, I would say, sort of making their first attempts at sort of presenting their proof of reserves. I think they have done, and I don't think it's like a one-shot thing. It's going to happen over a period of time. But as we see now that there is some degree of assurance given from Binance on their reserves, which I think is a good start. And I think the second part, obviously, is that, just because FTX has happened, we can't sort of assume that for all the other offshore exchanges. I think Binance has, over a period of time, proved to be a player that at least users have liked, which is reflected in its market share. Not just because it's a good product, but because I think they've had certain instances where they've demonstrated good security. I mean, there have been hacks in the past where Binance has made customers whole, and that sort of experiences have kind of stayed with the customers, and which is why you see a lot of customers trusting Binance, which is obviously reflected in its market share. So I think first thing I would say is that we can't sort of paint all the other offshore exchanges with the same brush. Binance, I think, has kind of built that track record of market share and user trust over time through multiple difficult situations, I would say, in the last 4 to 5 years, and we should not forget that. And then finally, I think they're making the efforts in terms of presenting their proof of reserves. And as that sort of information transfer comes in, I would also say that I think Binance, because it's such a systemically important company to crypto, I also think that what Binance is right now doing, and what the founder and the management team is doing, is sort of actively reaching out to different, countries and regulators and so on and so forth. We've in fact mentioned in our report as well that the founder has kind of traveled 43 countries in the last year. I think that is part of Binance's outreach. I think on the other hand, also regulators don't have a choice, because you're dealing with such a big mammal, such a massive company in the space who's so systemically important. You have to kind of interact and engage. So I think over a period of time, we'll also see Binance take this offshore to onshore path. I don't think we're there yet. I think it's a long grinding process, but I think that's the path going forward.
Yeah, I guess that's reassuring for folks like our prior guest, who's still very much a bull on Bitcoin. Gautam Chugani, thank you so much for your insight into what's going on in crypto right now. He's Bernstein's Global Digital Assets Managing Director and Senior Analyst. Coming up, we're going to speak to the CEO of Casey's from the floor of the New York Stock Exchange about beer cheese pizza.
Oh, yeah.
Among other things. We'll be right back. Shares of Casey's General hit a one-year high on Wednesday after the convenience store chain reported an earnings beat for the quarter and raised its outlook. Joining us now to discuss the company's results and the state of the consumer is Casey's president and CEO, Darren Rebelez. Darren, it's great to see you. I think we talked to you in your former role at IHOP. Haven't talked to you yet at Casey's. And obviously, we've been trying to get hints from CEOs like you as to what is going on in the broader economy. What say you in terms of recession, in terms of spending patterns, and what you're seeing among your customers?
Yeah, well, thanks for having me. And first, I'd like to just give a shout out to our 43,000 team members at Casey's who delivered another fantastic quarter, taking great care of our guests and the communities that we serve. With respect to the economy, obviously it's been a challenging environment with inflation and supply chain and those sorts of issues. But we've found in our geography, in our 16 states in the Midwest, that our consumers really been resilient. And we see some shifting patterns in terms of their purchasing habits, but overall, we've seen a really resilient consumer, and it showed in our results this past quarter.
Hey Darren, it's Brian here. Good to see you again. I'm going a hard turn here. Talk to us about this Busch Light beer cheese pizza. Where does an idea like that come from? How many of these have you sold, and do you have more innovation like that coming next year?
Yeah, it's a great question, Brian. And that was really the brainchild of our culinary team. And we're for people who may not know, we're the 5th largest pizza chain in the U.S. So we really lean heavily on innovation as one of those things to help drive consumer interest and drive traffic to our stores. And the team this time came up with the idea that because our breakfast pizza is turning 21, wouldn't it be fun to collaborate with a great partner in Anheuser-Busch and with what's a Midwest staple, Busch Light beer. And so beer cheese is on trend right now. Everything came together, and it's been fantastic. We've had record results in our breakfast pizza sales, and we've been doing it for 21 years, and so that's a big statement, but that innovation is continuing, and you'll see more of that innovation in the first half of the next calendar year.
Man, I don't know, Darren. I see that thing. I would go right to sleep after eating that pizza first thing in the morning. That's quite, that is like, that's your calories for the next day and then some.
Send us a box of those, Darren. Come on. We want to try. Julie wants one. Come on.
Well, it's good for the soul.
There you go.
Yeah, yes, that needs to be on every single box. Darren, while we have you as well, I did want to ask about some of the operating expenses, because there is an environment where consumers are leaning more into their credit purchases right now. That was something that was noted within the higher operating expenses, credit card fees, and then additionally, some of the profitability inside the store was also impacted because of those higher operating expenses. Where are some of those efforts to mitigate those higher operating expenses? Where can you pull those levers within the business?
Yeah, that's a great question. And we did see operating expenses increase in the quarter, but what I would say is that it was far less than what we were experiencing from an inflationary standpoint. And really, as we began this fiscal year, our team put a concerted effort around simplifying our store operations and engaging with our team members. Employee expenses are 3/4 of the expenses that we have in our stores, and so we really put an emphasis on trying to improve that team member experience and thus reduce turnover. And as a result, we've seen sequential improvement in our turnover every month this fiscal year, and really resulted in a tremendous reduction in overtime and training expense without impacting the guest experience. And so that's been the single biggest lever that we've pulled. The second thing is we have a phenomenal procurement team that goes out every day and is not only getting reduced costs of goods and reduced operating expense from our supplier partners, but in addition, really mitigating some of those cost increases that are being tried to pass through to us. So overall, between procurement and our team member engagement efforts, we're seeing some really strong performance on the OPEX side of the P&L.
Talk to me about fuel prices, because obviously that's a big part of your business as well, and we have seen fuel prices come down. On balance, is that a positive or a negative for you guys?
Yeah, with fuel prices, it's definitely a positive for us. First, we don't like to see high gas prices any more than the consumer does. It puts a lot of strain on consumer wallets, and we like for those people to come into our store and buy all the great products that we have, including our pizza. But when the fuel prices come down, our credit card fees come down. And to put that in perspective, we spent $60 million last quarter in credit card fees alone. And so anytime that retail price of fuel comes down, the credit card fees come down with it, and that impacts our operating expense in a positive way as well.
All right, Darren, I know we've got some excitement about the ultimate beer cheese breakfast pizza, but I just want to try the breakfast burrito sometime because that is like 75% of my diet is burritos. So would love to give that a shot if you send the pizzas as well. Casey's CEO and President Darren Rebelez, thank you so much for joining us this morning.
Thanks for having me.
Absolutely. Guys, coming up, hey Alexa, tip my delivery driver. We're probably upsetting a lot of Alexas in people's houses right now. We're going to share the details of Amazon's new holiday tipping plan, even though we just initiated it for many of your devices at home.
Hey Alexa, send me a pizza.
It's time for Cut for Time. 3 stories, 1 minute each. You know how it works. We're going to start with this. On the day, hundreds of journalists and other employees at the New York Times began a 24-hour walkout today after an agreement was not reached for a new union contract by the deadline. This is the first strike at the company since the 1970s. This is an effort to unionize, and not just that we've seen in this broader kind of sweeping unionization effort at Starbucks, at Amazon warehouses, but then additionally for some print publications as well, as they've been looking for better benefits and more stability at a time where their own publishing houses as well have faced a lot of challenges too.
So this is about more pay.
Yes.
That is mostly what this is about. And the negotiation has been going on for something like 18 months. It's been a long, ongoing negotiation. And so after this is when the union has made the decision, the guild has made the decision to do this walkout. So the paper's being put out digitally and in paper form by non-union employees today. So the guild asked people who read the Times to not read it today, which I didn't see until I'd already done Wordle.
As you should know, of course, New York Times, public company with a ticker on Yahoo Finance.
NYT.
All right. Yes, indeed. All right, my favorite story of today, guys. Dyson is making headphones that promise to not only block noise, but also unwanted airborne particles. They cost $949 and can only be pre-ordered by appointment only in March. And guys, these things look absolutely ridiculous. And on full cleaning capacitor, or however you want to, air filtration capacity, they only, wow, amazing. They only last 2 hours. So not only are you looking absolutely ridiculous walking around the street, you probably work using a product that I would say, I haven't tried yet, a little bit lower quality than the AirPods, and you look absurd and only last 2 hours.
Here to me is the use case.
You look like Bane.
China.
You look like
China
Bane.
is the use case to me. Like if I live in China in a very high air pollution area, like that's where something like this maybe would make sense. It's not for COVID, by the way. They say it's not necessarily, doesn't necessarily filter to that degree.
You know, just the design of this, I think that's what's really catching me off guard here. Yes, he does look like Bane, indeed. Bane with hair.
Yeah.
That man.
Maybe
However,
you have to clean that now? Are you going to clean that every single day?
I don't know.
A product only lasts 2 hours?
You replace the thing.
It's awful.
All right, finally, Amazon is tipping drivers this holiday season, but there's a catch. Customers have to thank the drivers via Alexa, and then the driver will get a $5 tip from Amazon. The driver with the most thank yous does get a bonus of $10,000. But to me, there's some issues with this. A, letting people know that it's happening so that you thank your driver. And B, that you have to have Alexa to thank that. Like my devices are not Alexa enabled. You can't, there's an option where you can go in the app and but like just pay your people more.
I mean, it's a nice incentive. No, I mean, look, to deliver more packages, get $10,000. It's pretty good. Nice little contest in the holiday season.
Is it about delivering? It's not about delivering more packages necessarily.
Well, deliver a good package, put it nicely neat on the steps, get a compliment, get a tip, and make some extra money.
Is the 10,000 net or gross? Because
it's an Amex gift card. No, I haven't.
It's an Amazon gift card.
Gift card.
Of course, is what it is.
Which is exactly what you want as a driver at the
Alexa,
end.
order me one of those beer cheese pizzas from Casey's.
Oh my gosh. And I don't know. I just feel like if you're going to give your people bonuses, give them bonuses.
Yeah.
If you want it to be merit-based, like I just feel like the Alexa
Instead of putting it on the customer at the end of the day.
I'd give you a bonus if I could, Julie. And you too, Brad.
I do
Thanks.
appreciate that. Thank
Same.
you very much. All right, well, that does it for us on this Thursday. Happy beer cheese pizzas to all of you. As we take a final look at the markets here, we've got all three major averages in the green. Pretty decided fashion. The Nasdaq leading the way. It's up by about 1.25%. Akiko Fujita and Rochelle Kufo back with more right after this break.
Welcome to Yahoo Finance Live. It is 8 a.m. on the West Coast, 11 a.m. on the East. I'm Akiko Fujita along with Rochelle Akufo. Here's what we're watching at this hour. Clamping down. A report from the New York Times suggests Sam Bankman-Fried could face a federal probe into market manipulation. This, as a leading House lawmaker corrects the record, saying a congressional subpoena is on the table. Policy shifts. China's reopening, a divided Congress, and a will they or won't they Federal Reserve. We are heading into 2023 with a healthy dose of uncertainty. State Street's Elliot Hentoff tells us where he thinks the focus should be. And tier fear. Disney Plus launches its ad-supported version, so should you switch to the cheaper plan and start enjoying some of those commercials? We discuss what 164 million global subscribers are likely to do. But first, let's take a look at the major indices. The S&P 500 looking to snap that 5-day losing streak we've been watching right now. So far, so good, at least 90 minutes into the trading day. The Dow is up 270 points, roughly. The S&P 500 up 35, and the Nasdaq seeing a bit of a rebound here, up about 1.3%. Let's do a quick check of where Treasury yields are headed right now. We have seen investors certainly firmly focused on that FOMC meeting for next week. Watching those yields closely, the 10-year yield right now up, and it's at 3.47% on the longer end of the curve. We are seeing the 30-year yield up as well. Well, we are starting this hour with the latest allegations surrounding FTX. The New York Times reporting federal prosecutors have launched an investigation into founder Sam Bankman-Fried for market manipulation. Now, they are specifically looking into the possibility he manipulated cryptocurrencies, Terra USD and Luna, to benefit assets that Bankman-Fried controlled. The New York Times reporting that the investigation is still in its very early stages. Any wrongdoing has yet to be determined. And Rochelle, as a reminder for those viewers who, maybe there's been a lot of news in the crypto land lately, but when we're talking about Terra USD and Luna, these are the two that saw a huge collapse back in May, when we saw huge withdrawals there. We saw the stablecoin Terra USD that was pegged or backed by Luna. That sort of led to a domino effect. You could argue the first domino effect we saw this year. The allegations here in the New York Times piece saying that Sam Bankman-Fried manipulated the market to see those currencies fall so it would benefit his assets, which include FTX as well as Alameda. And this, of course, just the very latest investigation around the collapse of FTX.
And it's incredible to see all of this really unraveling, starting, as you mentioned, with the collapse of Luna and Terra, and then to see it now translating into what we're seeing with FTX. And as you mentioned earlier, Congresswoman Maxine Waters saying a subpoena is on the table, because there was some confusion in a CNBC report whether or not SBF would end up testifying. They do expect him to testify on December 13th. And of course, we know that FTX was involved in a number of different sponsorships. At one point with Taylor Swift to sponsor her tour, that was supposed to be a $100 million deal there. That ended up falling apart, according to Financial Times, at around $4 million. You also have their sports sponsorships. We saw that they did that with the University of Berkeley, but then also trying to do that with Manchester United, with Liverpool, seeing those talks as well. So it does seem like a lot of ambition. You have to wonder how much of this is poor risk management versus, the numbers just don't add up in terms of what they had in terms of liquid funds and their ability to keep sponsoring these huge deals. It just doesn't make sense. It doesn't add up.
Well, at the core of the allegations being behind FTX is that they, in fact, commingled funds between Alameda as well as FTX. But, what's interesting about these allegations to me is that so much of this points to sort of the tentacles that exist within the crypto space. Of course, we should point out these are still allegations. The investigation is still in the very early phases. But if, in fact, what the New York Times is reporting, investigators are looking into are true, well, then you've got a situation where you've got one major exchange at the time, FTX, really trying to manipulate currencies for their benefit. Of course, there was that allegation in the fall, of course, on the back end of what happened with FTX. Some saying, well, was it, in fact, Binance's CZ who came out and said there were questions about the balance sheet after that report that came out from CoinDesk? Did he potentially pull that trigger that led to all the doubts around FTX that led to the collapse? There's certainly so much to get through to, but it is interesting to see so much of this being connected all the way back to what some would argue is the beginning of the crypto winter over the summer. Certainly something to be watching, but as you point out, investigation or multiple investigations advancing on many fronts here, not just with the federal prosecutors, but in Congress as well, and something we're going to be watching really closely.
Indeed, when you add to that class action lawsuits for people who lost out, not just on FTX, but the tokens as well. You have regulatory probes coming from the SEC. You have the Justice Department calling for a probe into the bankruptcy. And you also have the federal prosecutors in Manhattan looking into FTX's unexplained $8 billion shortfall in funds. So the tentacles, as you mentioned, continuing to spread. And I'm sure we'll get something new every day as we continue to follow all of this. Well, let's continue the conversation now with YouTube host and investor Matt Kohrs. So, Matt, I first want to get your reaction to what we're seeing in terms of what's happening, not just with the markets, and obviously a lot of people watching what's happening with crypto as well.
Happy to be here. Thanks for having me. So in terms of the overall market, especially through the lens of retail, anecdotally, I could share with you that if you're looking on Twitter, on Reddit, on Rumble, on YouTube, there's still a lot of excitement. And to me, that's kind of important just because of the fact that the market as a whole, I believe the SPY is roughly down 17%. And a lot of the major meme favorites among blue chip stocks, it's been a rough year. And I think that just all adds up to the restrictive monetary policy, which it seems like we still have a little bit more to go. But beyond the anecdotal evidence of people still exciting and kind of refusing to get out, just a study came out this morning that just 1%, a singular percent of retail traders are going with the opinion of selling in 2023 because of what's going on with the market. As in 99 out of 100 retail traders are still interested in the markets and interested where everything's going. And for the second part of your question of what's happening in crypto, I would argue roughly the same situation. It's been a brutal year. I mean, I believe Bitcoin at this point in time is down about 65-ish%. It's been brutal, but it's also a good learning lesson of this is the cyclical nature of the market. I believe that there are going to be a lot of crypto coins and tokens that end up failing and going to zero. But if we're looking at the thing that got it all started, Bitcoin, I would argue that it's kind of, in my opinion, an interesting investment at this moment in time, just because we already know from the SEC, we don't necessarily have to worry about regulations or anything among that, just because it's already decided that it's a digital commodity. And if we're looking at things such as monetary policy, not only here in the US, but globally, that makes a very enticing case for Bitcoin. So overall, if for anyone listening right now, my opinion is this, and it's kind of just reverberating the words of Warren Buffett of being greedy when others are fearful. And for me personally, I'm just looking to shop on a discount.
Yeah, Matt, it's interesting that you're saying there's still excitement within the market. We had TD Ameritrade on earlier this week, which of course puts out that retail report every month saying that at least with their clients, they were net sellers when it came to the last month. So where are you seeing the money moving? If it isn't necessarily in crypto, it's not in the usual meme stocks. Is it in the tech names? Is it in EV names? I mean, talk to me about what you're seeing.
So, I mean, once again, I think I get a certain view of the retail market, but just coming back to the, I guess, survey, the poll survey that came out, I believe, on Market Insider this morning, about 72-ish%, right there, about 3 out of 4 are still focusing on singular names. They're not looking at mutual funds. They're not looking at ETFs. They are still kind of throwing their support behind whatever company personally resonates with them. I wish I knew the exact sectors it was or wasn't going into. But really, I guess what I would argue is, even though I don't have that type of data, I think the rise of retail in 2021, of course, there's a little bit of a come down from that. But still, overall, we are net positive in the average Joes like you and me still interested in the market.
And I want to talk to you about meme stocks on our top trending ticker on our site, which is GameStop, after reporting a decline in revenue for the first quarter. But obviously, as you can see there, the stock up about 6% there. Where are we in terms of the meme stock story when it comes to GameStop?
I mean, that's the golden question. Are we closer to the start? Are we closer to the end? And in reality, I'm not a fortune teller. I'm not clairvoyant, but we're still seeing a lot of people day over day talk about it, trying to throw out theories of what is right, what is wrong, just like all these hypotheses that are being tested. And yes, there is, such as the earnings announcement, you get these fundamental updates, but through the world of meme stocks, I think this is one of the biggest things that a lot of people end up getting wrong. And I don't think it's intentional by any means, but what I'm seeing here is traditionally value always equaled fundamental value. And you could define that however you want. But I think with the rise of retail really starting at the start of 2021 and continuing now almost 2 years later, I would argue that the equation for the value of a company, it's a little bit more complicated. And my thesis is that it's at least value equals fundamental value plus community value. And we're seeing that not only in things such as GME and AMC, but before this, maybe to not as much of a degree, that's what we saw behind Berkshire Hathaway. I mean, these events out in Omaha, like, he's the Oracle of Omaha for a reason. He had a massive personal following. The same thing with Tesla and Elon. And we're getting more and more examples of this. And I don't think that type of investment is going away anytime soon. In reality, it just boils down to a little bit more of a complicated formula for what is value in the market.
Times like this, a lot of people quoting Warren Buffett, right? This is kind of when you go long. But Matt, appreciate you joining us today as always. Matt Kors, YouTube host. Well, a federal judge has thrown out a lawsuit accusing celebrities, including Kim Kardashian, Floyd Mayweather Jr., and former basketball pro Paul Pierce of allegedly misleading fans over their role in promoting a cryptocurrency. Yahoo Finance's Alexis Keenan has the details. And Alexis, of course, when this announcement first came down from the SEC, there was a lot of attention, maybe because it involved a Kardashian. What's the latest?
Yeah. So this is involving the same digital token that collapsed in a matter of a couple of months called Ethereum Max. Now, it's not related to the traditional Ethereum token ETH or ETC. It's completely different, just shares the same name. So here's what happened. There was this federal class action, that purported class action, that investors who bought this coin, they wanted to file in California, but the judge has tossed it out, at least for now. The defendants say they lost money because they relied on celebrity endorsements that were posted on social media by Kardashian and some of those others that you named. I think we have a couple of them that we can show you there. The first post that came from Kardashian was on May 30th of 2021 promoting EMAX, and then a second post on June 14th of last year. So just that small short period of time there, this token went from having value to having nothing at all, pretty much worthless. So the plaintiffs, they characterize this token as a pump and dump scheme. They said that's why they think they should be able to sue these celebrities as well as Ethereum's founders. But the federal district court judge in California, he said that the plaintiffs failed to make their case on a number of reasons. But look, it's not over. The judge is going to let these plaintiffs refile on certain claims that have to do with consumer protection statutes and racketeering as well. There are some of the cases that the judge is going to let them try to make. The judge did note, though, that there are valid concerns that are raised by the lawsuit. He said that the tokens, he kind of equivocated them to snake oil, saying that anyone with the technical skills and or connections can go ahead and just mint a new currency and create a digital market overnight. So he said absolutely there are concerns. And to your point that you mentioned, Kardashian has already settled with the SEC for $1.26 million in October over promoting this same token. She's also agreed not to promote these tokens for a period of 3 years from that settlement. Akiko?
All right, I'll take it from there. Expensive lessons learned indeed. Thank you so much, Alexis Keenan there, keeping us updated. Meanwhile, workers at the New York Times on strike today as talks between a workers' union and the paper fall through. The New York Times Guild says management has not bargained in good faith, while the Times said the strike action was drastic and disappointing. This according to the Washington Post. Now, the walkout comes as the New York Times continues to weather the economic environment in better condition than some of its media peers. For instance, buying the popular crossword game Wordle earlier this year. Now, the strike is set to begin at 1 p.m. Eastern and will last for 24 hours. And Akiko, we know at the center of this, it's really salaries that are at the center of it, but also things like retirement benefits, return to work benefits, and also some allegations of discrimination when it came to how employees were actually assessed as well, predominantly against Black and Hispanic workers. But this is a strike that this sort of strike that we've not seen in decades.
Yeah, you're certainly right about that. Since the 1970s. So we're talking about the first worker stoppage since 5 decades, roughly. And we're talking about 1,400 employees that are represented by the union. We're talking about reporters at the New York Times, comment moderators and security guards. I mean, there's certainly a lot of people represented here. And to your point, it is really at the core of it about pay. And I want to read through some numbers here that shows you just how far apart these two sides are right now. The Times has, according to the New York Times, offered union members a 5.5% raise. and then subsequently a 3% raise in 2023 and 2024. What the union is now asking for is a 10% raise. So we're talking almost double what has been put on the table here. And then following that, a 5.5% raise in 2023 and 2024. And, Rochelle, it's worth kind of pulling back and looking at the media environment right now. Sure, we just pointed out the fact that the New York Times has been largely profitable. And that's been the argument on the union side to say, look, you're making money and that should trickle down to us. But at the same time, we have seen ads pull back in a significant way. You think back to last week, right. Significant layoffs happening across the media landscape, including at CNN. So it's a tough environment on both ends, but it's going to be interesting to see how this all plays out, just given how long it's been since we've seen this kind of worker stoppage.
And when we look at some of the words in the statement from the unions, they said that the wage proposal still fails to meet the economic moment, lagging far behind both inflation and the average rate of wage gains in the US. So as you mentioned there, still very far apart in terms of what they're expecting in terms of wages. But when you look at inflation, when you look at what we're seeing with wage growth, it seems like they're pretty far apart on this. Not sure how this is going to pan out, but this is a 24-hour strike. So we'll have to see what comes of that. After that, it's been 40 bargaining sessions to get to this point and still at an impasse. So it's the end of the year. We'll see what happens in the new year. But at least for now, the strike for 24 hours. All right, coming up, a trifecta of risks: China's reopening, global inflation, and DC politics. Where should your attention be at an uncertain time? Well, we asked State Street's Elliot Hentoff what he's focused on next. What's driving China's great reopening? Well, investors cautiously optimistic over adjustments to China's zero-COVID policy, loosening restrictions as it hopes to restart a stalling economy. We're here with insight into China and a wider global market outlook. Elliot Hentoff, head of macro policy research at State Street Global Advisors. Good to have you on the show. So what are markets digesting? Because they didn't seem to be that pressed about China yesterday when we saw the reopening. What's different today?
Yeah, I wouldn't overinterpret the market moves. I think the challenge here is we know now China is going to reopen. Our own expectation has been that it would be largely open by March or April of the coming year. That time schedule now, markets are trying to play around to figure out, well, maybe it'll actually happen quite a bit sooner, maybe not. How smooth will it be? And so markets are feeling around, basically trying to forecast what does that mean for commodity demand growth? What does that mean for consumer consumption returning to China, et cetera, et cetera.
As you try to assess, though, the impact of a reopening, Elliot, how do you counter that with the potential of spikes in COVID cases? We've already seen a surge. We heard from Dr. Anthony Fauci yesterday saying there's a real concern in China trying to ease things up at this very time when they are seeing a spike in cases.
I think we've all been through this before in many other jurisdictions. The reality is, even if the rules fell away, the prevalence of the virus would mean that you basically would have economic patterns similar to a lockdown when spikes happen. And that's going to characterize most of the winter. So the reality is most of China will basically try to avoid the virus for the coming weeks and months. That's not I think nobody should imagine that things return to normal this December. That's not the case. So the question really is, when will this reopening process be somewhat complete? Is it February? Is it March? Is it a little bit later throughout the year?
So in terms of who will be the first initial beneficiaries of China's gradual reopening, which sectors are you looking at?
Well, there's a few. Obviously, commodities are one big factor, and you can see it in energy prices right now, which are trying to find a footing, trying to forecast to what degree Chinese demand comes back. And when Chinese demand comes back, it's obviously going to be a stimulant for a large chunk of emerging markets, particularly in Southeast Asia. And as that kind of locomotive pulls ahead, you'll start to see export demands for Eurozone goods also pick up. So that's where you can kind of feel the first initial dominoes to be, which would be obviously commodities, then certain EM industries that are located in Southeast Asia, and then of course luxury goods, automotive that come from Europe.
Elliot, when you look at other geopolitical risks, obviously the ongoing fight over in Russia and Ukraine, you've got Europe imposing their sanctions this week on Russian oil. I mean, are we looking at that largely as sort of priced into the market? I mean, how significant are the risks stemming from that? And what are the things you think investors could potentially be overlooking?
I would say a big surprise this year has been how well Russian oil production has held up in the face of Western sanctions. I think going into 2023, one of the big risks is that we suddenly get an underproduction, an underperformance in Russian output, and that would basically affect global supply too. What's still not clear from the oil price cap and the embargo that Europe has imposed is to what degree that will change the calculus for Russia vis-a-vis its export plans. Currently, the market is assuming that this will basically pass without disruption, and that it will pass without disruption because the price cap is basically above the price that Russia's actually getting right now in terms of oil anyhow. So they feel like, well, it shouldn't affect the outcome. But that's where the risks lie, both in terms of like natural degradation in terms of Russian output, as well as some unintended consequences from some of the sanctions and policy actions.
Elliot Hentoff, State Street Global Advisors, Head of Macro Policy Research. It's good to get your insight this morning. Appreciate you joining us. Well, let's turn now to a look at how crude markets are performing. As we said, some hopes here rising that demand could pick up out of China with those loosened COVID restrictions. Let's bring in Yahoo Finance's Inez Frey, who's tracking that for us this morning. Inez.
Akiko, and we've seen quite a bit of volatility when it comes to crude prices. When it comes to WTI, it's now in the red. It had been in the green. I'll tell you why in just a second. But also Brent crude down 1%. And this decline that we've seen with crude oil, I had been speaking to Andy Lippo of Lippo Associates. He was telling me, look, fears of a recession and this longer than expected full reopening when it comes to China is what's really been bringing these oil prices lower. As far as today, today's concern, we did get a headline about the Keystone Pipeline. That's a pipeline that runs between Canada and the U.S., and that producing a leak, so that had been shut down. So that's when you saw WTI spike higher. It has now come back off of those session highs. Just to give you an idea of what this has done to equities related to energy, well, you're looking at XLE down 0.1%. Over the last 4 days, quite a decline when it comes to XLE. You can see here down almost 6%. And year to date, though, still the best performer out of the sectors, guys.
All right, thanks, Ines. Right, coming up, changing the terms. Reports suggest Elon Musk's bankers could be looking for ways to switch up the Twitter deal through new margin loans backed by Tesla stock. Sound like another problem in the making? Well, we'll discuss next. Elon Musk has been contending with a myriad of issues since taking over Twitter. Now, one is the somewhat controversial financing structure of the deal. Now, Bloomberg News reporting that Musk's bankers are considering providing the billionaire with new margin loans backed by Tesla stock. Now, this would theoretically replace some of the high interest debt currently on the books. This would replace the $3 billion of unsecured debt, which Twitter is paying 11.75% interest on, Akiko.
Yeah, and when you think about it, I mean, the initial financing package did include margin loans that were backed by Tesla stock. So in some ways, you know, this is kind of going back to looking at that. Obviously, that was ultimately replaced by additional equity from investors. But, you know, bottom line, this is all kind of an attempt to ease the debt load for Twitter. And you pointed out the interest that they're paying on right now, the loans. We're talking about $1.2 billion. I mean, that's more than, you know, when you think about the revenue that Twitter is pushing out. And it all comes at a time when they are really struggling. You think about the advertisers who have suspended ad buys on Twitter. We've, of course, been talking over the last several weeks about the pullback that we have seen, or the cuts, we should say, thousands of employees that have been cut. And that's kind of put Elon Musk in a bit of a tenuous financial position where you've got $1.2 billion in interest that you have to pay on these loans that have been secured at a time when the company really isn't seeing that steady revenue. I mean, you could argue Twitter was already struggling even before this deal, but certainly that has been exacerbated by advertisers really pulling back.
And we know that ever since Elon took on Twitter, people were wondering, what does this mean for some of his other businesses? What does this mean for Tesla? A lot of investors probably not very impressed right now, seeing this continuing to come up and continuing to be a problem as he's trying to prop up Twitter. But this is what happens when you start a comment with a tweet that you're thinking about buying Twitter, and now look at the debt financing that has to go on now. So this is going to be an ongoing situation. I'm not quite sure how Elon is managing to balance all of this, but the banks, they're still stepping up here. They still seem to have some faith in what he's doing. But as we remember now, this is a private company. He's making a lot of very public decisions, putting a lot of things to polls, even if it's at the cost of advertisers. So it's a tough line to walk for Elon right now.
Yeah, I mean, with Tesla, you put the loan aside. It is about the concern about distraction, right? When you think about where Elon Musk is putting his attention, is this going to take away from Tesla? And Twitter, again, the bottom line for the platform, which has been a question for many, many years, which is how do you bring in additional sources of revenue when this is a model that was based on 80% or more of the revenue coming in from ad buys? And of course, it's not just about the controversy that Elon Musk has brought to Twitter. We're talking, we've seen a broader pullback in ad buys overall, especially on social media right now, as we've seen the economy slowing down. So something that we're going to continue to watch, obviously, but Bloomberg, which put out this story saying that this is still in the very, very preliminary discussions. Nothing has been set in stone, but we, of course, will continue to follow that. Well, coming up, falling in line. The Netherlands reportedly planning fresh controls over chip-making equipment heading to China. Is this a unilateral move or part of a growing alignment with Washington? That conversation is up next.
Turning now to some global headlines. The Netherlands set to expand its curb on the export of chip-making equipment to China, adding to US-led measures meant to throttle China's semiconductor capability. Now, such restrictions would bring the Dutch in line with US policy, which does aim to check China's control of the semiconductor market over worries of not just dependence, but also surveillance. And we know that this is an issue where, when you think about the global supply chain of semis, a lot of people are saying, yes, the minerals are located in China, but if you don't have the equipment coming from the Netherlands, and if you don't have that equipment that's then supplied by the US, what does this actually mean for the ecosystem, Akiko?
Yeah, and Rochelle, we're talking specifically about one company that is at the epicenter of this chip turmoil. It's ASML, which makes the machine needed by chip makers to print small designs onto microchips. They supply every major chip maker, from Taiwan Semiconductor to Samsung and Intel, and they do provide equipment that is among the most advanced chip making quality here. And it's interesting to see here, Rochelle, how the U.S. is essentially forcing, if you want to say the world, but especially U.S. allies, to pick a side. Because when you think back to what happened in October, the most stringent export controls that were put in place by this administration, specifically preventing American chip makers, all but preventing American chip makers from providing to China. They could apply for a license, although there's questions about whether, in fact, that would be granted or how lenient that would be. And then, of course, it prevented U.S. citizens from being able to work on these programs that would supply to China as well. So ASML has kind of been wrapped up in that already. They had advised back in the fall to call on their U.S. citizens or those who are working within the company to stop working on that because they didn't want to be in violation. But now you've got the Netherlands essentially saying, okay, we're kind of going to go along with this because the concern with the U.S. is even if the U.S. stops American, companies that provide chip making equipment, we're talking about places like Applied Materials, there are other providers who can provide to China, and that necessarily wouldn't cripple their ability to make the most advanced chips. Now, the other fear on this is that, let's say they don't necessarily comply, well, then they take market share away from American companies. So a lot of, we talk so much about semiconductors, but so much of this really is about the diplomatic negotiations that are happening between these countries who are, as you point out, Rochelle, really part of a global footprint that allows us to get the chips that are not just in our, devices, but also in military equipment. I mean, semiconductors have really, really come to be at the very center of a lot of these geopolitical tensions.
And you raise a good point, because when you think of everyone trying to have sort of their independence when it comes to the chip industry, it goes through a supply chain spanning multiple countries. So it's not as easy as saying, we want to just have our own chips. There's a lot of pieces in place. And when you factor in geopolitical issues with this sort of race for our high-tech future, it makes for a very interesting stew here. And it also means there's a lot of levers that if you're the one supplying the minerals or supplying the equipment, that you get to have a bit of leverage here. So an interesting dynamic that's emerging.
Yeah, full court press coming from the U.S., that's for sure. Well, let's now turn to the race for EV adoption. A lack of charging infrastructure has been one of the main obstacles. This, according to a study from San Jose State University. General Motors hoping to boost charger availability by leveraging its dealer network to choose charging locations in their communities and subsidizing the deployment cost. Joining us to explain is Haas Hassani, General Motors Vice President EV Ecosystem. Good to have you on today. I'm going to start with a stat I know GM always likes to mention, which is that 90% of Americans are within 10 miles of a GM dealership. So you've got that in place. Now you're allowing or actually offering up these charging stations to dealers to deploy. To what extent is that likely to accelerate EV adoption?
Well, Akiko, great to be with you. And one of GM's visions, ambitions is to have everybody in an EV, not just to see EV in the markets where we're currently seeing a lot of adoption. And that means in the heartland of the country, in the middle of the country, in ex-urban and rural communities, as well as communities that are currently underserved by EV infrastructure. So for us, getting 40,000 chargers deployed across the US and Canada in those communities, those thousands of communities that don't have a single charger there today, is hugely consequential in our view for accelerating EV adoption.
So Haas, talk about the decision to have them deployed in the community versus at the actual GM dealers themselves.
Yeah, I mean, listen, it's obvious and predictable that we would deploy them at dealerships. In fact, our dealerships are installing EV infrastructure on their properties as a condition of selling and servicing our EVs. But we thought the opportunity was to go farther than that, and not just to get charging more accessible, but also to start supporting local businesses, small businesses, communities, popular community destinations, and so forth. Since we announced the program last year, we had a number of businesses reach out to us and say, hey, I want to be a host for one of these locations. And we think bringing everybody in, which is not just the driver of the vehicle, but letting the communities participate, that is something that's very core to General Motors' identity and fabric in this community and in this economy. And we just think it makes a lot of sense.
Haas, a majority of these being deployed are level 2 chargers. And while it's on the faster end, we're still talking about, what, roughly 3 hours to get to 80% charge. I mean, what do you think is the tipping point for those who are kind of on the edge saying, well, should I get an EV or not? That's still a long time to charge up if you don't have a charging system at home.
For sure. And today we are seeing that 80 to 90% of charging is happening at home and a little bit at the workplace. DC fast charging makes up about 15 to 20% of the infrastructure. That's where you see those really quick top ups, half an hour to 80% and so forth. But 80% of the charging infrastructure in the US and Canada today is that level 2 charging. And it serves a different use case. When you think about locations that people hang out at and spend a lot of time at, a couple hours at a library, at campus, at school, at an employer, and so forth, that's really where level 2 charging makes sense. It's more affordable to charge on level 2 charging. And in fact, a lot of level 2 chargers across the continent are in fact free. And so we see level 2 charging really complementary to the investments that we're also making in DC fast charging as part of our $750 million commitment to expand EV infrastructure across North America.
And what sort of headwinds could you also be looking at as you try and expand this?
I really think the only headwinds are our own ambition, frankly. And what we're doing here, we just, the immediately preceding segment talking about, continued challenges with supply chain and so forth. We've, of course, partnered with companies, and we've got a good view here that those 40,000 chargers that we're looking to deploy, we will deploy in the time frame that we're looking to do it. One of the other advantages of level 2 charging infrastructure versus DC fast charging, you require less upgrades and utilities and so forth. It's much quicker to install. In fact, we've had our first installations through this program in Wisconsin and in Michigan, and are looking to build on that with hundreds and thousands more installations in the months ahead.
Haas, how much of this is about trying to get drivers to warm up to the GM EV brand? I mean, we heard from your president, Mark Bruce, several weeks ago, saying that, GM's actually serviced about 11,000 Teslas. And while you've been open to that, there's got to be a bit of a wooing game that's happening, right?
Well, without a doubt, listen, I mean, up until now with gasoline-powered vehicles, it's always been about brand reputation and the product itself that has made, really inform people's decisions which vehicle they were going to purchase. When you get into electric vehicles, that is, of course, there. Having stellar product with excellent, range, reliability, and features and amenities, and the brand's reputation really matters. But one thing that is fundamentally different about an EV is the fact that charging is, in most cases, a daily ritual for folks at home, whether they're plugging it in overnight like they do their phone, whether they're going on a road trip, or that is an experience that they're going to be having much more frequently than a gas fill up in a very good way. And for us, we know that General Motors is absolutely going to lead in that charging experience that people are going to have every single day. And that's going to be hugely consequential to the decision of which EV people want to choose. And so combine that with the exceptional vehicles that we're going to have, electric vehicles in every category from Equinox up to Celestiq, and that world-class charging experience powered by the app, powered by the in-vehicle experience, we know that that is going to catapult General Motors to the leadership category in EVs.
We know more charging stations certainly sweetens the deal for people on the fence thinking about EVs. Haas Stymie, General Motors Vice President, EV Ecosystem, thank you so much for joining us this morning. All right, coming up, key price points. Disney Plus launches its ad-supported tier, and Kantar, for one, thinks around 25% of subs will switch to the cheaper plan and get into those commercials. We'll discuss the future of streaming next.
OpenAI's new chatbot named ChatGPT is gaining online traction as users test out the capabilities of this AI-powered information tool. Here to break it all down with the details, we've got Yahoo Finance's Ali Garfinkel. Ali, to say this is getting traction, I think is an understatement. My Twitter feed, at least, has been blowing up with people testing this out. What have you
Mine too, Akiko. Yeah, it's really blown up. I don't know if I've ever seen an AI tool go quite so mainstream. And there are a couple, for anyone who's not as chronically online as you and I are, there are a couple of things that are really important about this. The primary one is this. This is the most sophisticated AI chatbot that we have ever seen released to the general public. And it was developed by OpenAI in San Francisco, and its applications are honestly pretty broad. I've seen the applications range from completely silly, like there's one that went viral about a King James Bible verse about getting a peanut butter sandwich out of a VCR. And, the applications can also get really scary. For instance, someone figured out how to get past some of the content filters and get it to tell you how there's a Molotov cocktail, how to make a Molotov cocktail. So the range of applications are broad, but there are a couple of simple ones. Some people are using it to clean up their code. Other people are using it to help draft cover letters. There's been a lot of applications surrounding college essays. The way it works is essentially you sign on and you type a question, much in the same way you would to something else we're all very familiar with, Google search. So I actually went and tried it out myself because I wanted to test out this idea, because there's a lot of hub being like, well, this is something that, could eventually replace Google. And I think there are a lot of things underlying that, but I asked it a couple of questions that you might ask Google. One of them was very benign. It was about French toast. It'll probably show up on the screen here in a second. Here you go. Yeah, I was just like, what's a recipe for French toast? Okay, that's a recipe. And then it shows you how to make French toast. I also asked it a follow-up that gave me excruciating details on how to add chocolate chips in. So I think there are a lot of questions that this poses, but there's no question it has gone completely viral.
I love this. I'll definitely be checking that out. A big thank you there to Ali Garfinkel for us. Well, Disney Plus's ad-supported tier goes live, and users can now opt for a lower price tag for a Disney streaming subscription as consumers feel the pinch amid inflation. Now, the move comes as the media giant pulls streaming profitability into focus, but how will it shape up against the competition? We're here to discuss. We have Geeta Ranganathan, Bloomberg Intelligence Senior Media Analyst. Good to see you, Geeta. So with the introduction of this new tier, what do you think this means in terms of the competition and in terms of the price range as well?
Yes, it's a really interesting move by Disney here. They're hiking up their prices on their premium product by almost 38%. So you're going from about an $8 product to $11. But at the same time, they're giving consumers that option because they're introducing that ad-supported product at $8. So for anybody who kind of feels that pinch, of course, they can spin down to that ad-supported product. And remember, this ad-supported product is not necessarily going to be, filled with commercials. They're trying to keep the ad load pretty minimal. It's only 4 minutes per hour versus the 8 minutes that you see on Hulu versus the 15 minutes that you see on linear television. So they're kind of trying to do it in as smooth a way as possible, keeping it very, very less intrusive and less disruptive to the viewing experience.
Geeta, 2 questions. How many users are likely to switch over or downgrade to the ad-supported tier, and to what extent is this going to drive additional revenue for Disney?
Yeah, so right now we have about, 165 million subscribers on the Disney Plus product. We think, at least in the United States, anywhere from about 20 to 30% of the US subscriber base could look to kind of go down, spin down or trade down to the ad-supported product. But again, it really, we have to kind of wait and watch, because if you look at Hulu, and Disney owns Hulu, they own 66% of Hulu. Hulu, actually, if you look at their profile of subscribers, almost 70 to 75% of Hulu's subscriber base is on the ad-supported version. So it's been a huge hit. Ads have been a huge hit with Hulu. I think it's going to be a little bit different with Disney Plus, but I think, again, we can expect to see at least a third of the user base kind of convert to that ad-supported product over time.
Now, when you compare it to something like Amazon Prime, obviously they have a different ecosystem that involves shopping and everything else when you get the Prime membership. How does Disney stack up in terms of that, and also in terms of global reach? We know that at least for Netflix, they're looking internationally for reach.
Yeah, so Disney also has an international product. And remember, again, with Disney, you brought up Amazon Prime, which is a really, really great example. And remember, Disney just a few months ago was kind of looking to introduce a product very similar to Amazon Prime and call it Disney Prime, where they would kind of have this membership, not just to their streaming product, but also to kind of merchandise, also entry into their theme park. So they are also kind of looking to build that ecosystem. We're not really sure where they're going to go with it right now, but arguably, I mean, they have the best content. They have the best streaming content in the industry. They have some great franchises. They have some great IP. So they know that, subscribers are going to come. And if you just look at some of the numbers that Disney has posted ever since they launched their product about, 3 years ago, I mean, this is a company that has added about 45 million subscribers year after year on their Disney Plus product. So just some staggering growth there, and expected to grow even further, with this new ad-supported tier. In terms of how much revenue they can generate, I think it's going to be a little bit of an early, a slow ramp, if you will. This is still early days, but they do have a nice template there with the Hulu ad-supported model. So we expect Disney to generate anywhere from about 500 million to even up to $1 billion in ad-supported revenue on the Disney Plus product in their first year of operation, but expected to be somewhere like 2 to 3 billion going forward in the next 2 to 3 years' time.
Yeah, you could argue in some ways that the timing is right. A lot of families trying to cut costs on the streaming side of things, and this offers an alternative. Geeta Ranganathan, Bloomberg Intelligence Senior Media Analyst. Good to talk to you today. Well, coming up, Neighborhood Watch. Airbnb is cracking down on disruption from unauthorized parties this New Year's Eve, and it might change your plans. More on this up next.
New rules for New Year's Eve. Airbnb announcing a global crackdown on unauthorized New Year's Eve parties by guests. It will ban one-night bookings of whole home listings by certain guests, as well as restricting those same guests from booking longer reservations. I feel a bit bad because obviously if you'd already booked your New Year's party, this is going to come as a big blow to you, but they're putting up these defenses to try and be as respectful as they can and try and crack down on some of these parties, Akiko.
Yeah, and let's sort of break down the restrictions because, as you point out, Rochelle, this isn't a blanket ban on one-night bookings. This is for guests who specifically don't have a positive account history, or they haven't had previous bookings at all. And this, of course, you know, a lot of people are thinking about this, Rochelle. Why not have a party, right? You go rent out a big space for New Year's Eve, and Airbnb says, well, that's not exactly respectful of the platform's rules. Now, they did roll out this specific feature in a very limited capacity, and they have said last year that led to 340,000 guests globally being blocked or redirected from attempting to be booked on Airbnb. This year, they're rolling out in 11 countries, including Spain, the UK, Netherlands, Portugal, Ireland. So be warned, if you are out there trying to plan a party on Airbnb, it's not going to go over quite smoothly.
I mean, I wonder why they picked these 11 countries. I mean, I know in the UK we like to party, but I don't know about singling out these particular 11 countries. I feel a little bit attacked in that. But I mean, obviously they're trying to, as you mentioned, they have this criteria. They're trying to keep things respectful, keep people wanting to get more on the platform. We know that they've been trying to get more people on the platform as renters. So, you know, I do understand. But we're going to have to leave it there. So if you have those New Year plans, good luck to you. But before we go, we're going to do a final check of the markets. Let's see where the major indices are at the moment. As you can see, they're in positive territory, a different turn from yesterday. We see the Dow up more than 220 points, the S&P up about 30 points, and the tech-heavy Nasdaq up just over 1% at 122 points as well. Well, that'll do it for myself and Akiko. We'll be back tomorrow at 11 a.m. Eastern. That's 8 a.m. on the West Coast. We'll see you then.
Reminder.